We're challenging the status quo. We're a legacy-free bank. We were built from a PowerPoint presentation from a blank piece of paper with the sole focus of providing the best service to small and medium-sized businesses. This is the challenger mindset. It's a very exciting time for us, and this is why we've been so successful in attracting the very best business bankers.
Find out what boldly backing business actually looks like. The expert bankers at Judo Bank choose to come and work for Judo Bank so they can enjoy the craft of true relationship banking.
We know that every single small and medium-sized business is unique. They all have a unique set of requirements which Judo is set up to provide.
A customer value proposition really focuses on getting the best bankers in the market. We have an operating model that ensures that our bankers are spending as much time with their customers and as little time doing bureaucratic administrative tasks as possible.
Our strategy is really anchored around the best of the past with the best of today. The best of the past was very much that highly skilled, highly trained relationship banker, bankers with exceptional credit risk management skills, exceptional interpersonal skills. They're empowered to make decisions quickly, and they can build an enduring, trusted relationship with their clients over many, many years. The best of today is today's technology, today's pace, and today's science of how to use data and a digitisation agenda so that our business bankers can spend significantly more time with their customers.
Any bank can tell their customers that they love them, but the folks at Judo Bank are on a mission to prove it.
You're going to want to hear this.
Have a listen to these true Judo stories.
Judo Bank have been absolutely critical to our growth. It's been a fast growth period. Judo have been there with us the whole way, and we're looking forward to growing the business even more.
We've built a team around us, and Judo are a huge part of that team.
We have had some extremely significant growth from where we started to where we are now.
Since Judo has come on board, we've been able to grow the business substantially.
With Judo's help, we have achieved our projections, which is now allowing us to grow the business even further.
The future of Remax Revolution is big, and we're looking forward to a lot of growth with Judo. We're so excited.
With Judo on board, it's helped us more than double our business.
We're not here to build a small bank.
Good morning, everyone, and welcome to Judo's 2025 Investor Day. For those of you I've not yet met, I'm Yan Hong, Judo's Chief Legal and Commercial Officer. I open by acknowledging the traditional owners of the land on which we meet this morning, being the Gadigal people of the Eora Nation, and pay my respects to elders past and present, and also extend that respect to any Aboriginal and Torres Strait Islander people joining us here today in the room and online. So this is our second face-to-face Investor Day, and it's heartwarming to see some familiar faces from our first day here in Sydney in 2022. It's also pleasing to see a whole set of new faces this morning joining us in the room today. I also like to warmly welcome some of our customers who have joined us here today for a panel discussion later this morning. They are the reason for Judo being here, and to some of our bankers and brokers who are the reason that Judo gets to do what we do. We've not chosen this venue by chance. We're here for all that the Sydney Mint represents, being the first branch of the Royal Mint outside England. And I think no one can really argue with the fact that being able to print your own money really does help drive economic self-determination. Thus, this place was more than a coin factory. It enabled greater financial stability, and this autonomy really laid the groundwork for local entrepreneurship and the growth of a vibrant small business sector, the sector that we have built Judo from the ground up to support and to advocate for, which you'll hear all about today. And it's the fuel that continues to drive us forward. I've been a banking and finance lawyer for 25 years, having worked at Macquarie, Deutsche Bank in London and NAB, as well as law firms Herbert Smith, Freehills Kramer and Linklaters in London. This is my 6th year at Judo, and sometimes we joke that the years at Judo can feel a bit like dog years, mainly because what we've achieved in such a short time really is extraordinary. And we rarely take the time to celebrate our successes, which is why a day like today has been a good reminder for us to look back on the journey so far. Standing up a bank can feel a bit like a marathon and a sprint all at the same time. But I speak for the team when I say it hasn't felt like hard work. Because not when you're running alongside a team of like-minded, passionate people who, like me, came to Judo to build a bank, who share a strong focus on a strong purpose and are chasing the same great outcomes for our customers. Obtaining our banking licence and the IPO were our two big hills to conquer. But now we find ourselves at a great jumping off point, with this foundational work behind us and the operational leverage which comes from the payoff on our earlier investment. It continues to be a super fun and exciting place to be, especially with our ongoing focus on the judo culture and our values. Preparing for this day has been a good time to reflect on where we are now, and I still marvel every single day that we are running a profitable ASX 200 ADI that is dedicated to supporting so many Australian SMEs through our amazing cohort of talented relationship bankers. It is a tribute to our judo team members and their energy, as well as your belief in us as shareholders that this has been our reality. The executive team from Judo are here today, and you're going to hear from each of them about what's happening at Judo and what's ahead for us. We're pleased to give you some insights on what we're working on and what we're looking forward to delivering in the near term. So next, you'll hear from Chris and some of our exec team, followed by a panel discussion with our customers, bankers and brokers. And after the morning tea break, you'll hear from the rest of the exec before finishing with the Q&A section. So again, welcome to all of you, and I'd like to hand to Chris now to kick off today's agenda.
Thank you, Yen, and good morning to everyone here in the room. I think I probably know you all personally, and thank you to everyone that's joining us online this morning. We really are looking forward to updating you on our strategy today, and I'm also excited that you'll get to hear directly from my leadership team, which I can honestly say is the most talented group of executives that I've had the pleasure of working with in a 42-year career. Before moving into the strategy, I wanted to briefly recap on the trading update we provided on the 1st of May and confirm that we remain on track to achieve our updated FY25 guidance. April was a soft month with all of the public holidays, but we had a strong month of lending in May, resulting in a loan book as I stand here today of $12 billion. Pleasingly, our pipeline has also grown significantly and now sits at $1.9 billion, up another $300 million from the 1st of May, despite the large amount of settlements that occurred in May. Our NIM guidance is unchanged from the trading update. Costs are under control, and our CTI will be lower than FY24. On cost of risk, as we've said many times before, this does have the potential to be volatile. In April, our 90 days past due and impaired did see another minor increase to 2.59%, and we still expect our FY25 cost of risk to be slightly higher than last year in dollar terms. But ultimately, we continue to manage all the levers available to us and target 15% PBT growth on an underlying basis. Now to our strategy. A reoccurring question I'm asked is whether the major banks' rediscovered love with business banking is making it harder for us to scale. The short answer is no, and so our goal today is to explain why. In fact, I'm more confident than ever in our sustainable competitive advantage and our ability to build a world-class SME business bank with leading ROE. Our raison d'etre back in 2016 was to solve what we believed was a market failure in the provision of credit to SMEs, a problem the market couldn't solve for itself. The major banks were and continue to be on a path-dependent journey of industrialisation. That cannot be reversed. Cost-cutting and driving higher returns is a fact of life at a major bank. The founders considered architecting Judo within a major bank, but in reality, the competition for capital and funding, the need to comply with group policies, the weight of legacy infrastructure, and an environment where executives were on a constant merry-go-round meant the idea of starting a completely new division with a new culture was simply impossible. Literally, the only way to start Judo was to start with a blank piece of paper. And here we are, a bank with no legacy products. For context, a major bank was recently promoting that they were going to reduce 1,200 products to under 450 with their tech transformation. We have just 4 products. In fact, when I was at Standard Chartered, I had 900 different credit cards alone. Many of these products are actually off sale, but they're a significant source of revenue, and that makes the complexity very hard to unwind. Secondly, we have no legacy sales culture. I mean, this really is essential for a business bank. Money is the easiest thing to sell. It's getting it back that requires skill. And when I did my apprenticeship in the 1980s, banks had a risk culture, not a sales culture, and customers respected that. SMEs are not experts in finance, so they need a banker that is. Thirdly, we have no legacy bricks and mortar. I mean, the largest business bank in Australia has 85 business centres. We have 0. The best and only place to assess credit properly is on the customer's premises. Fourthly, we have no legacy technology. We are completely cloud native, technology as a service, avoiding the multi-billion investments needed to modernise old systems. And we have no legacy compliance. I mean, the majors are investing over $2 billion a year now on their regulatory compliance obligations. And lastly, but most importantly, we have no legacy people. Now, it's no one's fault, but the reality of a major bank is that half the people have been in their jobs for decades, and it quite simply isn't the bank they joined. And this drives disengagement and mixed capabilities. As a result, every policy is calibrated to the lowest common denominator across a vast distribution of people. Whereas in Judo, every person has been handpicked for their skills and cultural fit, and they're passionate about SMEs. With the benefits of starting with a blank piece of paper, we set about designing our specialist business model with 3 key elements. First, a customer value proposition for SMEs and only SMEs. Second, a unique employee value proposition to empower bankers. And third, systems and processes to support growth. Competition comes and goes. Today, business banking is getting a lot of attention, coincidentally when the economics of a home loan have been eroded and the economy is transitioning from a consumer-led economy of household leverage to a business-led economy of investment. But our focus on the craft of SME banking is enduring. It's all we think about, it's all we talk about, it's all we dream about. We understand that every SME is unique and different, and they value a relationship with a highly skilled, highly trained relationship banker, which is the opposite of the major banks' continued journey of industrialisation and an operating system which favours lending against property. What business owners want more than anything is service, the ability to speak to a banker who understands their business and is empowered to make decisions quickly. Someone they can build an enduring relationship with over many, many years to earn trust. Broken down, our customer value proposition has 3 components. First, smarter judgment. Second, faster decisions. And third, stronger relationships. Why is judgment important? Because every single SME is different and they all require a solution for their specific situation. They don't want to be told, or when they call the bank, they don't want to simply be asked, how much is your house worth? They want to have a conversation about their situation and the opportunity in front of them. Speed is important because SMEs want and need certainty. If you have an opportunity to secure a new customer, but it comes with a working capital need, then you need an answer immediately. Not let's schedule a meeting for next week and then I'll go and talk to credit and you should have an answer in about a month. In fact, a fast no is far better than a slow maybe, but a strong sales culture often delivers the latter. And relationships are built over time, based on human-to-human interaction. Our customers have their banker's mobile number, and that banker has only got 28 customers. And creating this model was only possible with a blank piece of paper. Bank industrialisation and the dominance of a sales culture has replaced judgment for algorithms, scorecards, policies, separated sales from credit, which is fundamentally slow, and it's replaced one-on-one contact with many-to-many via contact centres. This is how you run large distributed businesses. You have to reduce cost, eliminate variability, and remove conflicts of interest. And once this type of industrialisation is implemented, it's impossible to undo. But having an idea to start a bank was one thing. The reality of building a bank is something completely different. We honestly can't find another bank that has been built from scratch anywhere in the world and has been able to scale as quickly as we have. We reached profitability within 3 years of receiving our banking license, with a market-leading employee value proposition for bankers and a customer value proposition that everyone now says they're replicating. But yet we have the highest NPS in the sector by far. We were granted a full banking license in 2019, the first in decades. We also became the first bank to list on the ASX since Macquarie in 1996. And building a bank happens in stages. Back in 2016, we planned for sort of 3 times 5-year horizons of growth. The first 5 years we labelled building the bank, the second 5 years we labelled scaling the bank, and the third 5 years optimising the bank. And 10 years in, we have completed the second phase of scaling the bank, and we're entering the exciting phase of optimisation, which is also, for the accountants in the room, known as operating leverage. Raz will cover this later in the presentation, but in short, over the last 3 years, our technology team has replatformed our core lending system, our core deposit system, and our origination systems. They have re-engineered our data environment, replatformed our credit risk engine, our general ledger, and our digital platform. It's hard to overstate the significance of this achievement. At the same time, we've built all the supporting functions required to run a bank at scale, including legal, finance, risk, operations, human resources, and marketing. So the good news for investors is that the risk of building and scaling is largely over. So what does this next optimization chapter look like? Well, it's boringly consistent with the original vision. For us, our consistent, simple strategy has been the key factor of our success. We are and continue to be solely focused on the SME sector. Our strategic priorities are to enhance our core business, grow our TAM, optimize funding, capital and costs, and create new avenues for growth. Now, Frank and Andrew will cover these areas respectively. The full focus of our technology team is now turning to banker enablement and new products. If we're honest, the focus of scaling the bank over the last 3 years, as well as navigating the repayment of the term funding facility, has meant that some important projects were put on hold. But now it's so exciting that the full force of our technology and operations teams has shifted to new products and banker enablement. My job as CEO is to ensure we continue achieving the optimal balance of economics and growth. We are very much a growth company, but we're also a bank, which is valued on ROE, and as CFO at the time of the IPO, I was the architect of the key business metrics at scale. And optimising our pathway to these metrics is our combined objective, and we're well on our way. Lastly, I'd like to introduce you to Judo's executive team, a team that could run any one of the big 4 banks. The team in front of you has extensive experience operating in the Australian market and knows the landscape intimately. This is important because business banking is a contact sport. You must know the market, understand the economy and the local regulations. In my experience, business banks must be run by business bankers who understand how to structure and price credit risk. And bankers want a boss who understands the industry they operate and understands the craft of lending. One concern I often get challenged with is that we're a young bank. I'm often told Judo has not been through a credit cycle. I get quite upset by this comment. You know, the bank may be new, but we are not. This is my 42nd year in banking. I started in 1983, but my first business banking role was in 1988 when I lent my first dollar, I should say pound, in Barclays Bank in England. We're all deeply experienced executives with a combined experience of 200 years in banking. Equally, our customers are not startups either. They are seasoned operators. We actually do not lend to startups. And as executives, we've seen ups and downs and navigated through uncertainty. Together, we bring the discipline, the experience, and the track record that coming from knowing what it comes to scale and grow a bank. And on that note, I'll now hand over to Frank, and I look forward to coming back to the stage later for questions and answers and also to wrap up. Thank you.
Thank you, Chris. By way of introduction, for those who I've not met, my name is Frank Versace. I'm the Chief Strategy and Growth Officer here at Judo. I'm also one of the original employees and have held various positions over the past 8 years, including the Chief Relationship Officer role, which runs our banker team. I was also Judo's Chief Risk Officer before assuming my current role. Prior to Judo, I spent almost the entirety of my career in various technical and leadership roles across ANZ and Macquarie Bank, always in the commercial segment. Today I'm going to cover a number of different topics. Firstly, we're going to talk a little bit more about what Chris just mentioned around industrialisation and the market failure that has created Judo's opportunity to bring our unique CVP to market. We'll provide an update on our TAM for the first time since our IPO. And finally, we'll detail some growth opportunities and talk through our channel economics. As Chris mentioned, the raison d'etre for Judo has always been grounded in a firm belief that the market for SME finance is materially underserved. The structural factors which have within the segment have created an opportunity for Judo to establish a clear set of competitive advantages, which are both highly valued by the SME community and extremely difficult to replicate by our competitors. This is the faster, smarter, stronger that Chris just referenced. The key question, especially against the backdrop of major banks supposedly falling back in love with SME, is whether this market failure, and therefore our opportunity to establish genuine competitive advantage, is real and sustainable. I'm going to demonstrate why we believe the answers to both those questions are a resounding yes, as well as the considerable scope for growth which lies ahead of us. To understand the smarter element of the smarter, faster, stronger CVP, it's important to understand the unique nature of the SME economy. No other area of the lending system exhibits the same level of borrower variability across all factors relevant to a lender. SMEs are different to home borrowers, where most are PAYG and there is only one collateral type. And they're different to corporates, where organisational structures and information quality are relatively consistent and efficient. To unpack this a little bit further, the typical number of entities within an SME banked by Judo is 4 or more. That's 4 or more balance sheets which house the assets that we typically lend against. That's 4 or more profit or loss statements that need to be reconciled for internal cash movements and include various ownership structures and need to be properly understood to understand different tax treatments. These are not structures which lend themselves neatly to algorithms or automation if you want to properly assess them. Despite this, in efforts to lower service costs, the industry has over decades sought to increase the numbers of centrally decisioned credit applications, primarily via the use of probability of default models. The big problem here is that, as with every probabilistic model, the assessments they make are subject to 2 distinct types of error. Type 1 errors, also known as false positives, which in banking terms is the likelihood that an uncreditworthy customer is inadvertently approved by a model. And the creatively named type 2 errors, or the false negative, which is to say the potential that the model incorrectly declines a creditworthy customer. The important thing to note here is that banks are significantly more sensitive to type 1, as this represents a potential loss, versus type 2, which effectively represents the foregone revenue of an incorrect decline. In fact, studies show that banks are up to 10 times more sensitive to type 1 errors, and consequently models are calibrated to be far more conservative than they would otherwise need to be. This means the model will decline significantly more lending, up to 10 times more lending, to good businesses and force them into more rigid terms. These customers are usually easily identifiable to an experienced banker capable of applying underlying judgment in determining a customer's repayment ability, the sort of analysis that good bankers historically have always done. These customers represent an important component of Judo's client base, what we refer to as our half moon. The customers which sit outside the perceived appetite of our competitors but are actually fundamentally creditworthy. It also explains how we've been able to keep our risk costs suppressed whilst achieving above system margins. Just to give you an example of smarter being applied to a Judo client. We recently had a hospitality owner who had successfully bought, built up and sold numerous venues, who had deep industry experience and established supplier contacts over numerous years, was seeking to purchase a new establishment in a startup, in a special purpose vehicle. But in the absence of historical financials that applied to that vehicle, the application was declined by one of our competitors before the client was introduced to Judo. Let's move to faster. The pace of commerce often dictates that businesses are required to apply speed and certainty from a lender. There are several factors which structurally embed our ability to deliver high-quality decisions at speed. Firstly, we've spoken at length about the quality of our bankers and the team-based ethos which enables us to empower them properly and to undertake face-to-face decisions in market. Where transaction complexity necessitates, our credit managers are embedded within our banker teams to ensure that assessments occur with the benefit of local knowledge and that, importantly, every customer has the opportunity to meet the ultimate decision maker. This is completely unique as a value proposition in the Australian finance market. As you'll hear in more detail from Raz, our plans in the area of banker enablement include artificial intelligence investments to drive efficiencies for bankers and provide more impactful insights for our customers. Critically though, even the most advanced AI models draw a critical distinction between prediction and judgment. Harnessing tech advancements to drive greater system speed, increase banker time to engage with customers on value-add activities is central to our present thinking. And in addition, over time, we believe there is an opportunity to harmonise the predictive power of AI and the irreplicable elements of human judgment, and this will be core to our long-term agenda. A faster example we often see is a business who needs working capital support to enable the acquisition of new contracts. On usual industry timelines, this application can take weeks or even months, and growth opportunities are often lost. At Judo, we commit to turning these opportunities around in days, allowing businesses to get on with what they do best. In terms of the stronger element, we have spoken often in high-level terms about the superior relationship offering provided by our model and our bankers. We know that in every customer survey done across multiple years and conducted by numerous lenders, relationship is routinely more highly valued than a cheap price. The big problem is, what does that mean? What is it that is truly valued by a client in terms of the relationship they carry on with a bank? We have done extensive research on this subject through our existing customers and in the SME community more generally to determine a framework that we call the moments that matter. This provides our bankers with the pivotal moments in the customer journey where client expectations of the bank and the banker are heightened and defines the key actions and behaviours that are required as part of the delivery of our proposition. These include all initial and subsequent lending interactions, insights provided at customer reviews, and how the bank responds through periods of difficulty. A stronger customer example is an introduction made by one of our industry expert bankers to a client looking to scale through acquisition to another client known to be looking to exit. This achieves a positive outcome for all parties and establishes the banker as a genuine partner in the growth plans of the acquiring firm. Moving on to TAM, over the past 7 years, we know that our CVP has clearly resonated with many SMEs, driving above sector growth and industry-leading net promoter scores. The next question is, how big is the market? How much runway remains ahead of us? And what enhancements can we make to increase our market penetration? In our prospectus in 2021, we presented independent analysis of the total addressable market, including a conservative figure for unmet credit demand, but excluding several areas of the market that we had yet to enter. At the time, the TAM was sized at $605 billion, and we have now conducted an updated analysis and determined that with the ongoing increase of the SME lending system, our expansion into agri, growth in unmet credit demand, and the addition of high ROE warehouse lending, our addressable market today sits at $814 billion. Thus, we remain materially below 2% in market share, and whilst there will be parts of this TAM for various reasons that are not yet accessible, there is still significant growth opportunity for our proposition. I now want to expand on some plans for investment and focus that we have agreed for the coming year. In the core business, we'll continue to focus on deepening the share in the new regions and locations we entered in 2025. The warehouse lending business, which we have been incubating over the last year, will be another avenue for growth. And this is part of a multi-pronged strategic opportunity that we have identified to partner with high-quality private credit firms to capitalise on the ongoing growth of that segment. In terms of product mix, we have often stated that our initial product suite had a bias to simplicity, whilst also seeking to accommodate the vast majority of SME lending needs. There is, however, scope for product enhancement, and in the near term, we'll be exploring opportunities to enhance our working capital offering where we are presently underweight. We know that working capital is among the most prevalent funding requirements for SMEs and also typically more lucrative from a bank perspective. As such, working capital enhancement plans are designed to drive greater penetration of this market, greater product functionality, and an overall enhanced customer experience relative to our current offering. The initial thinking here is focused on providing greater payment optionality for customers through our line of credit product as a first step on a multi-year path to provide much greater flexibility and enhanced growth support for Australia's SMEs. Staying with product, but moving to the other side of the balance sheet, again in our early phase we targeted simplicity and funding stability in the area of term deposits. This strategy has served us well. However, we believe the time is right to introduce new deposit product options to provide additional funding flexibility. Again, this will be sensible and measured. We are currently in the process of building 2 new at-call products, which will effectively double our deposit TAM. Firstly, the business online savings account, which will be offered via our existing intermediary partners who currently offer similar products via their platforms. This product is designed to serve customers with savings held in self-managed superannuation funds, as well as entities seeking to effectively manage their cash flow management. This will be followed by the launch of a high-interest online savings account with a broader audience and more product functionality, and will come online in the back half of FY26. This savings account is designed to promote consistent savings habits rather than relying on short-term introductory offers. Through this approach, the bank aims to attract customers who demonstrate stable and sustainable savings behaviour. Neither of these offerings represent a move into customer transactional accounts, given the cost and complexity issues that would be introduced with these products. But both offer a path to funding cost improvement, given the discount to term deposit funding which these products are typically offered, and the cost optimisation of our term deposit book that these products allow. As such, as well as the greater market opportunity in the area of deposits and funding, over time, the introduction of these products should allow us to increase our NIM or to expand lending TAM into cheaper lending segments whilst maintaining our current economics. Finally, I wanted to touch on channel strategy and channel economics. One of our key assumptions we made prior to the launch of Judo was that the origination mix between broker and direct would be at 50-50. This was in line with our view of system at the time, and the reality is our book has settled at 75-25 and is not expected to change materially in the core business over the medium term, though will be skewed to direct in the area of regional lending and warehousing. We have conducted a substantive analysis of the broker channel, both in terms of the behaviour of our broker portfolio relative to direct, but also a deep dive into the forward-looking trends across the wider system. Firstly, I think it's worthwhile addressing the material differences between the residential mortgages broker system and the nature of the commercial system in terms of understanding the likely outcomes for residential and commercial lending. In commercial lending, our offering is channel agnostic. We have the same credit underwriting standards and processes, unlike what is commonplace in the residential segment. Our bankers always meet the client. We obtain and analyse customer information and determine creditworthiness in the same way, irrespective of origination channel. Secondly, rather than offering a competing proposition to our relationship offering, our broker partners and Judo bankers fulfil quite distinct functions in the customer value chain, which ensures that we are optimising the skills and structural advantages of each. Put simply, great commercial brokers need great commercial bankers, and great commercial bankers need great commercial brokers. We have experienced no material difference in terms of margin, runoff, or credit quality between our channels, either direct or broker originated. And internal unit economics suggests a relatively similar cost profile once origination cost benefits of broker originated deals are offset against the upfront and ongoing commissions of those transactions. These facts are critically important to understand that we have no channel conflict, and this has allowed us to forge a genuine tripartite relationship with our valued broker partners. In terms of our forward-looking strategy, a recent internal study of the broker industry concluded that it was likely that there would be some material shifts over the coming years, which we are uniquely placed to take advantage of in terms of our ongoing support for commercial brokers. Namely, where a decade ago there was a disequilibrium between demand for broker services relative to their supply, today that is no longer the case. With 22,000 brokers in the system, equating to roughly one broker for every 1,200 Australians, the industry has likely reached maturity. The vast majority of these brokers are focused on the residential sector, and few of these have the technical capability to provide genuine value add to an SME customer or to a commercial finance transaction. Where the rest of the industry is compelled to deal with the entirety of the sector, with all of the structural inefficiency that introduces, we have always been focused on a small group of skilled and experienced commercial brokers who we have integrated into our value proposition. We do not see high-quality brokers as a necessary evil in the way that it is often referred elsewhere in the industry. Our brokers are partners, and we were incorporating that philosophy into our forward thinking. In terms of trends, from here, our belief is that technology will progressively disintermediate brokers operating in commoditised parts of the market, or force higher degrees of industry consolidation, whereas those dealing with more complex customer needs will be more sophisticated, more prominent, and more important. As I just mentioned, this aligns with our strategy from day one in focusing on a small group of capable brokers, and our emphasis over the coming year will be to create more formality in terms of our partnership with these firms, more overtly recognise the role brokers play in the customer value chain and the delivery of our value proposition, as well as establish greater alignment in terms of incentives and financial outcomes with our nation's top commercial brokers. This will enhance our irreplicable competitive advantage we already have in this area and will firmly entrench us as the bank for commercial brokers. Thank you. I will now pass to Jess and look forward to your questions during the Q&A segment.
Thanks, Frank, and good morning, everyone. My name is Jess Lantieri, and I'm Judo's Chief People and Culture Officer. I joined Judo just over 3 years ago now, and I joined this incredible business because I was really drawn to its deep purpose to serve Aussie SMEs and also because of its standout culture. So I want to begin by talking about our culture and why it continues to be fundamental to Judo's success. From the very beginning, we've held the belief at Judo that no company has a culture. Every company is a culture. It's our secret sauce, and it's a collection of the little things we do every day to make Judo a great place to work and attract the very best business bankers in the industry. We were thrilled to be named an AFR Boss Best Place to Work for 3 years in a row, recognising our relentless commitment to culture and being the preeminent employer for SME bankers in Australia. At Judo, we've set about intentionally creating a culture of teamwork, trust, accountability, and performance, our core 4 values. And we've hand-selected every single person that's joined our team to ensure cultural alignment to these values. One of the first things we do to preserve our culture is bring all our new starters together for a unique week-long induction program where we give people the space to detox from their prior organisation and immerse themselves in the Judo way. No one is exempt from this process. It's a non-negotiable, regardless of role or level, and just ask Raz and Renee, who joined last year. Time and time again, I hear feedback from our new bankers about just how different their experience is of Judo to the majors from day one. Just last month, one of our new bankers was telling me that for the first time in her 15-year career as a business banker, she went to visit a customer alongside her credit counterpart and that she'd never experienced that level of collaboration before. The system at other banks simply does not allow for this. Yet it's not only possible, but encouraged at Judo. and that is the difference between a risk culture and a sales culture. So there are three things I want to talk about today. Firstly, how we're attracting and retaining the very best bankers in the market through a strategy that is uniquely different from our competitors. Secondly, how we're engaging and empowering our bankers. We're a bank built by bankers for bankers, which empowers and enables them to work with customers in a very different way to the other banks. And thirdly, how we're actively investing in our bankers to ensure they stay with us and they have long and fulfilling careers at Judo. We're really proud of the exceptional talent we attract across our business, and in particular, the calibre of bankers who want to work at Judo. Today, we have a highly engaged team of 159 relationship bankers and 64 analysts in 29 locations. The bankers who come to us understand and are passionate about the craft of SME banking, banking as it used to be and as it should be. On average, the bankers that join Judo have more than 15 years' experience, and they're highly skilled, highly trained relationship bankers who want to provide excellent service to SMEs. The biggest difference between Judo and the major banks is that we hire bankers for their credit skills, not their sales skills. We have a rigorous recruitment process, which normally involves 3 to 4 interviews, and when a banker is ready to join us, there is only one thing standing in the way between them and the job, and that is a 3-hour closed-door, closed-book credit exam, which tests their skills and understanding of judgment-based lending. To this day, the pass rate on our credit exam has never exceeded 50%, so you can guess where the other 50% still work. This is core to all elements of our CVP, which Frank spoke about: faster, stronger, smarter. Not just because the bankers need to have good credit skills in their own right, but because it creates mutual trust and respect with the credit team. This trust, along with our differentiated reward structure, is the foundation of our ability to truly empower bankers. We have designed our reward structure and way of working that reinforces the behaviours consistent with these values. There is one critical differentiator between Judo and the rest of the industry. We do not have individual sales targets. The Banking Royal Commission showed the dark side of sales targets and how they lead to poor customer outcomes. We have one company-level balanced scorecard and an all ships to shore reward model with team-based incentives. The lack of individual sales targets means that bankers can operate in what we call a pod structure, small, agile teams of bankers and analysts focused on generating the best customer outcomes. The absence of individual targets results in strong and effective teamwork and load balancing where the right customers can be allocated to the right bankers. In contrast to sales targets, and consistent with our desire to reward and recognise bankers for exceptional credit skills, we make additional rewards available for bankers based on the Judo belt scheme. This is a clear merit-based pathway recognising exceptional credit skills. So in a nutshell, the higher the belt, the higher the lending authority, the higher the incentive opportunity. At other banks, as bankers have evolved into salespeople and credit has been centralised, lending delegations have gradually been diluted. But our belt scheme means that bankers have genuine delegated authority to lend. They can confidently visit a customer and shake their hand, knowing they're empowered and have the authority to do that deal. We know this is one of the reasons bankers love working at Judo most. Progression in the belt scheme is evaluated against Judo's lending delegation framework by our credit leadership team. It's based mostly on credit skills along with other performance criteria such as cultural contribution and behaviours. We've seen through this scheme that our bankers are inspired to progress, and it's created momentum within the cohort towards continuously developing credit skills and attaining higher belts. As an indication, we expect about 30% of our banker cohort to receive amount above their standard STI opportunity for this year, based on their credit capability and other performance criteria against the company scorecard. With our strategic investment in credit capability and training, we expect to see a significant uplift in the amount of black belt bankers in FY26. And again, we've been able to build this structure with this unique focus because we've had the benefit of building a bank from a blank sheet of paper as our starting point. The service profit chain underpins a lot of how we think about our business. And the punchline of the service profit chain is this: highly engaged employees result in more satisfied customers and better business outcomes. Hence, investing in our culture, which promotes highly engaged workforce, is an obsession for all of us. At Judo, we don't subscribe to traditional methods of measuring and monitoring employee engagement, which normally means a tedious, long annual engagement survey of over 200 questions. By the time you get around to implementing the engagement actions, they're already out of date and the mood of your team might be completely different. So we actually measure employee engagement weekly through the Judo Employee Delight Index, or what we lovingly call JEDI. JEDI is a 2-minute short text sent via a 2-minute survey sent via text to the whole Judo team each week, which has simple sliding scales and an opportunity to provide comments. We ask about things like how you felt about your week at Judo, your emotional connection to our purpose, your physical energy, your mental energy, and your ENPS. JEDI helps us to listen to our people quickly and respond effectively. It's a regular pulse check. It helps us listen, learn, react, and manage the needs of our people, both big and small, in real time. So let me give you a live example to bring this to life. Just last week, our bankers told us that coffee was a must during this particularly busy period of high lending demand. So we listened and rolled out free coffee carts across the country. Not only are we getting our much needed caffeine fix, but it's a great way to connect with colleagues and share customer stories. This kind of approach has truly helped us deliver consistently high engagement results and real connection as we grow. It should not come as a surprise that our banker cohort typically has the highest engagement scores across Judo, reflecting their passion for bringing to life our CVP. We recently did a JEDI study that found a direct correlation between banker engagement scores, banker performance, and customer satisfaction. We know that higher banker engagement levels directly correlate to customer NPS. Our data proves the service value chain exists. This unique data set also provides us with powerful insights. We know that at Judo, physical energy, which is fueled by connection with co-workers, is the top driver of engagement. And as such, we spend so much time investing in a collaborative culture. We know this makes us different, and this is why we invest so heavily in culture. Our high engagement levels also translate to low voluntary attrition rates, which has been stable among our bankers and is lower than industry average. Some people have left Judo because they miss a sales culture, and honestly, we're okay with that. But interestingly, in the past 2 years, we've had only 12 regrettable losses, 8 have gone to commercial broking, and only 3 have gone back to the majors. The bankers that become brokers have a deep understanding of our CVP and are very strong referrers of new business as they understand us and they're great advocates for us. Though interestingly, a new trend we're starting to see is that some bankers who've become brokers are actually returning to banking because they miss the culture and the environment of teamwork. Lastly, I want to touch on how we cultivate a strong talent pipeline, which is a strategic focus for my team. Since 2021, we've been running what we call J Factor, our internal annual program to accelerate the best analysts into great Judo bankers. The program combines materials delivered by Judo's own experienced credit and relationship team, as well as world-class providers like Melbourne Business School. We have, on average, 12 to 15 analysts annually who complete the program and are promoted to Judo bankers. We're proud of our homegrown bankers that we're adding to our already strong banking team. Now, as a people business, people-related costs make up the bulk of our cost base. So running a successful analyst development program is actually an effective tool to manage wage inflation, while also embedding and protecting our CVP and our culture. So in summary, we've not just built a bank, we've built a bank for bankers, the bank we've always wanted to work for ourselves, and a community of exceptionally talented people across our broader business who are deeply aligned with our purpose to support Australian SMEs. Thank you, and I'll now pass to George Obeid to host our customer panel.
Good morning all. I'm George Obeid, Judo's Chief Third Party Officer. I joined the business back in Feb 2017 and largely to establish and run the third party business. I'm so very pleased to host the panel discussion today and introduce some very special guests. First, we have Faris Dedic, Managing Director of DIG Advisory, Koi Capital and Red Door Finance. Dan Baggett, Director and owner of DTM Property and Dan Baggett Construction. Ami Mahendran, General Manager of Plenty River Plumbing. And our very own Lucinda Carroll, Regional Director of Agri in New South Wales and ACT. And before we get started, I thought I'd play a few videos which will give you some background on our guests.
In my previous role, I worked in banking. I understood how to analyse a business and what makes a good business tick. I saw a big opportunity in the small business sector with a lot of people retiring without succession plans. With Judo's help, we were able to successfully buy a thriving small business and grow it to then acquire 3 other businesses within equipment hire, e-commerce and garden maintenance.
We know what a good operator Ami is. It was really the trust and the relationship we'd built with Ami over the years that helped give us confidence that the next business and now the 4th will all be successful.
Judo were the first bank that actually looked at what work had I done to show that I could grow this business.
If you've got a smarter banker that understands what the client wants and is trying to achieve, it makes getting the transaction done much faster and also easier for the customer.
We want to grow to 10 businesses and we want to grow our revenue by 5 to 10-fold over the next 5 years. Judo Bank have helped get me to where I am today, and I see them being able to help me scale my business in the future.
Our passion is to provide a place where children feel safe, then they get nurtured and they grow.
I was introduced to Hassan and through his broker Faris. Hassan is an expert in his field, a visionary, and someone we want to be on the journey with. Hassan identifying areas where there's undersupply or there's demand needs for childcare centres. There's enough opportunity within Victoria, and Hassan knows this.
My role is to grow the business. And when I keep looking into the opportunities around leaseholds, there are a block of lands available, some business to acquire or land to acquire, we just go to see if Judo got an appetite for these projects. So we have a very strong pipeline.
Smarter banking is using my knowledge, applying all that I've learned to find unique solutions for the client, building a strong relationship with Hassan. Put that all together, you can get better outcomes and much faster outcomes.
We have great plans. Judo step forward and say, yes, we see your vision, and they supported our projects. I'm very thankful to that.
Our customers appreciate the speed to market. They appreciate dealing with a banker who's been in region, that understands the industries that they're operating in, and they also really appreciate a deep relationship.
I grew up on a farm outside of Mudgee, and there's not one day that I don't look forward to going to work. Mudgee Storage Sheds and Mudgee Industrial Park is owned by myself and my wife Sandy. Judo takes the time to understand your business and 100% supports where you want to go. Great Ice Station, it's always been back in my mind. And the ownership of Mudgee Industrial Park and Mudgee Storage Sheds, Judo Bank offered to consolidate the whole thing.
Just made sense given how successful the commercial businesses were in Mudgee. This would just be part of his business and he would continue to drive wealth and success for his family.
Because we had built an existing relationship, we understood the transaction and the opportunity for growth.
I'm very excited about the future with Judo. Quick answers, quick decisions. I just think the next 5 years is going to be a profitable one. I can't wait.
That was excellent. Thank you all for your time. To begin, I'd like to start by just asking each of you to introduce yourselves and also answer one question. Why Judo? What have we done differently? Maybe I'd start maybe at the other end.
Yeah, so I'm Army. I run a caravan plumbing business. That was the first business I acquired. I've expanded into acquiring an e-commerce business, and also a landscape maintenance business, all with the help of Judo. The reason why I chose Judo is when I got started, I didn't have much money to my name, I was 26, I didn't have property portfolio, and so I reached out to a lot of people. I raised money from investors, structured a deal with a business that had been around for 30 years and had a retiring owner who was willing to stay around and reinvest a little bit. And so we mitigated a lot of the risks, but I just didn't get heard when I picked up the phone and called 20, 30 different bankers, until I picked up the phone and got on the phone with Judo, and they listened and they really got into the business and understood the business. And ever since then, they've done the same thing with all my future business acquisitions as well.
Excellent. Thanks, Army. Faris?
Hello, everybody. Faris Dedic, Managing Director of Red Door Financial Group, Dig Capital Advisory and Koi Capital Management. It's a financial services group of businesses that crosses residential mortgages, commercial debt advisory and private credit in a non-bank space. Our core clients are business owners, property investors, property developers, and what we call emerging family offices. Core ticket sizes are $1 to $150 million, and client portfolios between $5 and $250 million. Judo plays an integral part to our clients' portfolios as a challenger bank to obviously the majors. It provides certainty, consistency, reliability, which is what we sell to our clients, and it really challenges the status quo of relationship management. So Judo's a deep stakeholder of ours and a great solution for a lot of our clients.
Thanks, Faris.
Good morning, everybody, ladies and gentlemen. My name's Dan Baggett. I'm the owner of DTM Property Enterprises and Dan Baggett Constructions in Mudgee. We own Mudgee Industrial Park. It's 11-acre property there that's heavy industrial land that I've been developing for the last 25 years. And we own Mudgee storage sheds. It consists of over 300 storage sheds. When I got introduced by Judo Bank through Darryl Groves, a very close friend of mine. He's a broker in Melbourne there. He was actually my bank manager back when I was 26-year-old, and he was only 25 at the time, and we still have a very close contact now. And he was the fault of me sitting here today introducing. I've got to thank him on that one. He introduced me to Judo, and seriously, it's just next level. I've always struggled with the big four banks. That's another story. It's Judo's actually provided me with diverse commercial and rural lending. They believe in the story, a dream, ambitions that I've got. And it's all character based, and I've never ever experienced another bank like it. Just the personal touch, it's when we first got introduced, Lucinda, Tom and Josh came to Mudgee on a personal note and introduced themselves, and that gave me the opportunity to show them my portfolio of properties and just to prove to them that I need a bank to back me. And I'm looking so forward to the future with Judo, and I think we're partners now. I strongly believe that. It's just lending is about forward projection. It's not historical look in the rear vision mirror. It's they take me on merit and credit. And from a guy from the bush, where I actually started growing up, we come from a very poor family, and it's it's proven that from starting from nothing and working hard, and because I probably classify myself as a very hard worker. I think the saying is work smarter, not harder. Well, I'm probably the opposite, and I work hard. As silly as that might sound, but there's not a day goes by where I just love going to work. And I just thank Judo so much for taking me on board, and I really, really appreciate it. I'll never forget it.
Excellent. Thank you, Dan.
I have to tell a story, Dan. Last night at dinner, you're getting itchy. He said, I love being in the big smoke, but gee, I want to go back to work. So I'm Lou Carroll. I'm based in Orange, so it's really nice to be here. It's a bit warmer than Orange here today. I'm the Regional Director for Judo Bank Regional New South Wales and ACT. I've been with Judo for just over 12 months, and prior to that, I had 20 years across a few different institutions, both domestically and in the UK. I'm a country girl too, from northern New South Wales. Small business runs in my blood, farming family, and proud to do that today too. We've got our own small farming business on the side in my spare time at Orange. But as I said, it's always run in my blood business. Sort of the formative years of the 90s, we'd go home from boarding school and we'd talk about interest rates and commodity prices and all these things that young kids probably aren't otherwise exposed to. And it really instilled in me a passion for small business and the work ethic that Dan spoke about. You know, and never a day went by that I didn't see my parents just slaving just to get things done. So here I am 20 years later, and I just feel like I'm just about to start my career and the impact and the positive contribution I can give to regional New South Wales.
Excellent. Thank you very much, Lou. Now, I'd like to open up to questions. So if any questions, please, there's circling mics that will come around. But in the meantime, while you're thinking up your question, I'll start with yourself, Faris. So in terms of Judo, why do you bring business to Judo versus the major banks?
For us, and I guess our business, you know, I'm only 31 years old. I'm going to be in this industry for hopefully the next 30 years, depending on how regulation goes and what happens and the defractionalization of the advisory industry. But ultimately, we're on a journey with our clients. There's, you know, whether it's true or not, in the Australian, they're saying there's over 600 non-bank lenders in the market right now. Our job is to translate the market to our lenders and ensure that we can give them the best solution at any one point in time for their business journey. And so for us, Judo gives us, I guess, an ace up our sleeve. You know, I always compare it to my team as the Latrobe of business banking. What Latrobe did to residential lending in a non-bank space is what Judo's doing very well in corporate finance. And they have a moment in time and in that client's journey. You know, these two gentlemen flanked to my side are perfect examples of that. I haven't met them previously. This isn't scripted, but we've got a very young, ambitious gentleman who wanted to scale a business, wanted to lever up, wanted to leverage purchases of businesses, and he found a bank who would back him. And that's a relationship under management model that allowed him to scale and grow his business and be heard and want to and be ambitious. And in an economy that isn't, I guess, pro-business, having a bank that is pro-business ensures that, you know, clients can grow their portfolios. And then you have gentlemen to my right who were bank clients and weren't listened to by the banks and couldn't get the right products by the banks and didn't have a relationship business model. And for us, we sell that relationship piece to our clients, and Judo exaggerates that. And yes, they're the ones that pay us, but at the end of the day, so do all the other lenders. For us, it's getting the best solution for our clients and ensuring that they get the best outcomes and they get the highest return on equity and the highest return on debt and the highest return on investment, and Judo allows them to do that.
And how does that differ to the banks at the moment in terms of what their offerings are in market?
I mean, it's tacky because I know, you know, this has been drilled into me for Judo Bank, but you know, that stronger, you know, that faster, that mentality that Judo Bank has. If I have a client and I take that client to a major bank, I have to make the client fit the box for obvious reasons, for securitization, for scalability, for the fact that bankers are for the fact that credit's taking the power away from the frontline bankers to be able to make transactions. So I have to really mold the client to fit what it is that the bank wants, and then I'm trying to plug in different banks to find different solutions. So if we look at a typical client's portfolio, we might have some of their property lending with a major bank, and then we'll have to put some of their leverage lending with a private credit provider in a non-bank space, and then we'll have to take some of their development stock to a non-bank financier. What Judo allows us to do is to put it all under one umbrella and I guess take the power of what is Australian securitization via PPSAs, GSAs, various different securitization methods to be able to risk rate the client accurately and allow the client to grow. And so, you know, The difference with the other banks is they can't give me the product suite. Sometimes there's an internal bureaucracy. So does the client fit small business, or do they fit business bank, or are they property bank, or are they private banking, or do they fit all three, or do I have one bank or two bank or four bankers, or do I have a transactional bank? With Judo, it's one contact. And then they give power to their front line to be able to make a decision, and not a decision that I can necessarily influence. They just have well-equipped bankers who are remunerated correctly on a front line to make the right decisions and then be able to scale the client from there.
Yeah, experienced frontline bankers with the ability to apply judgment and know you and know your client needs, right?
I might say this because I think it's relevant, but all of the bankers that are in the market right now, they get to a point where they can't grow in the banks anymore, right? So they hit a certain salary cap, they can't get their bonuses paid, or their risk rated on a certain transaction, and they can't grow. Now, like we all know, wherever you're employed, you either want to learn or you want to earn, right? And so what happens for a lot of bankers in the market is they get to a point where they're not learning anymore. In fact, they're hamstrung, they can't make any decisions, and they're not earning any more money. What Judo's done very well is they've onboarded those bankers who still have ambition in them, and have empowered them to learn the credit process, learn the whole life cycle funnel of the transaction, and their bankers know everything about the business, but also earn. Make sure that they don't have put their principal at risk, make sure that they're making the right returns on market, make sure that they're getting the net interest margin that the bank needs to get. And so I can tell as the front line, I don't run the balance sheet and that's not my expertise, but I can tell that the front line is empowered and is aligned with what the balance sheet strategy of the business.
Excellent. Thank you, Faris. As question?
I'm not sure if you can hear me, but great stories. Thank you very much for coming and sharing them. I'm sort of interested to know, compared to traditional bankers, Judo banker, can you maybe explain a little bit more about how they assist you in not only sort of lending solutions, but also perhaps business? That they're more engaged, they have a different skill set, that perhaps even in times when you're going through challenges, they're there to support and maybe provide guidance, almost like an advisory style board, etc. So maybe give us a bit more understanding how that works.
Great question. Ami, I'll throw over to you.
Yeah, so I think that's really the crux of it, is why I would always stick with Judo, because I recommend everyone in the room to actually try and secret shop at the banks, pretend to be a small business owner and try and approach the business banks, and you'll really get a feel for what it's like as a business owner talking to the small business end of a Big Four bank. I've done it. It's incredibly frustrating. And when you talk about Judo, the first time I approached Judo, I had a 45-page slide deck about why this business was a good business, about the customer concentration, the pricing power, the margin dynamics, the working capital profile. And they sat there, and not just the relationship bank I dealt with that day, but numerous that I've dealt with since, including people from credit and people from other parts of the bank, they spend the time to understand what is the business model. And that's what allows them to then understand how to ride the highs and the lows. I've had my business, the EBITDA's grown 4 or 5-fold. And then I said to them, it's going to come off a bit. And they understood why, and they were able to then help me through that journey, and they weren't panicked on the other side of it. And so I know tomorrow I can go and save 100 basis points by going to a Big Four. But the amount I'll lose out in terms of how they're going to structure my loan, how they're going to underwrite the risk, and what I can actually do in the future. To Faris's point, I'm 31 as well, and I want to be doing this for a long time. And there are going to be good times and bad times. And I feel like if you secret shop the banks, you'll answer your own question in terms of understanding the difference in caliber, in terms of I couldn't imagine discussing even a simple thing like pricing power or working capital cycles with someone from a Big Four, just respectfully, someone from the small business end of a Big Four bank, because I've tried to do that and I've failed.
Excellent. Thank you. Dan, anything else to add?
Yes. I've been building in Mudgee for 37 years, and I've been a developer since I was been 26 years of age, and I've always, I bought my first house at 18, half share with my brother, and it all sort of derived from where we sort of grew up from nothing to where we are today. But to actually meet a good bank manager, there's been very far and few between. Like the NAB Bank, I might as well mention them. I'm here. I speak from the heart, and it's the truth. There were good bank managers years ago, and they gave you a sense of support, and they really believed in what you wanted to do. If you put a business plan in front of them, especially developing wise, we built from a duplex to, up to 33 lot subdivision house and land packages, and it was just so hard, It's because, there's nothing wrong with the regional managers out in the bush. They all support you because they know the market. I know the market, and with all the approvals in place, and once it comes to Sydney and into credit down here, they've got no idea what happens in the market up there, and that's the real problem that I've faced over the years, and it's cost me a hell of a lot of money, and with the banks today, the major fours, they're all historical lenders. They always look in the rear vision mirror, not like Judo. They look forward. And they absolutely appreciate where you've come from and what you are today, and seeing assets that you've actually built from nothing. It's a credit on both sides because it works.
That's excellent. Really raw, honest feedback. Really appreciate that, Dan. Thank you. A question off the table in my left here. Thanks.
Thank you for taking my questions. Can you just clarify for us, when you first came across Judo, had you been knocked back from a major bank, and when you came to Judo, was it product, was it speed that initially got you over the line when you didn't know much about Judo initially, and also if you're comfortable with it, can you share, what was ballpark the initial lend that you were looking at when you started with Judo, please, just to give us an understanding of how you joined Judo?
So I used to work in investment banking and private equity, and then I moved back to Australia and I wanted to structure a deal. So I had a lot of contacts at all the big fours across institutional, emerging credit, but of course I had to be emerging corporate. I had to be talking to the small business side of the bank. So I had a lot of warm introductions. Despite getting warm introductions, I was banging my head against the wall, trying to communicate about what I was trying to do. The mindset is so deep. I think every man and his dog in Australia is a property developer. So they only know how to ask, what property do you have? And I actually had that experience for people. And when I said I didn't have any property, they asked, what do your parents have? And that was the experience I had on more than one call. I actually interacted with Judo by submitting a web form because someone told me, try BOQ, try Bendigo, try Judo. I submitted web forms. I was trying to talk to anyone I could. And then the level of understanding from that very first call, because a relationship director called me the same day. And then they went through, what am I trying to do? What does the business do? As I discussed before, what is the business model? And that was really different. It wasn't about product or this or that. I was looking for a cash flow lend, which is something that is not, the banks are just so focused on asset backed purely. And so cash flow lending was the product that was after, but really it was the caliber of the person on the other side of the phone that made the difference. And in terms of initial lend, it was 2 million Australian dollars. And then since then, currently I think I've drawn over $10 million since then with Judo.
Faris?
I might add as well, we don't, in our business, we're very particular with the clients we take on because, I always say in our business, we're very long-term greedy. So our reputation is everything with who we bank. The clients that we take to Judo aren't non-bankable clients. The clients that we take to Judo are clients who want a little bit more leverage. They're clients who want a faster response time. They're clients who want to have a relationship with their banker. Interestingly, they're clients who don't want to move their banking from their existing bank because it's too much of a headache. I've got a few of those clients. They have all of their transactional banking and their terminals linked into CommBank for argument's sake, but CommBank won't support the business banking. And so we go to them and we say, well, how about we just take it to Judo? You can leave your core banking as it is. I know you don't want to talk to your bookkeeper or your accountant. And let's put a solution into it. And that's why we use Judo. So it's not a lender of last resort. Actually, far from. There's a significant amount of lenders in private credit who are lenders of last resort. Judo's not. I actually think that their credit policy is quite tight at the moment, and there's a lot of work that my team has to put into getting the credit papers right and getting the data right to make sure that it transacts. But an example is, for example, ATO debt, right? A client who goes into ATO debt might not, you'd think that's a bad client, but they could have just had one, contract that fell over and they got 100 grand in ATO debt. And I had a recent example where we were restructuring a client at NAB, emerging corporate. It was a $42 million transaction. And we had to carve out different pieces of the transaction, and a particular piece that we took to Judo, and we're talking about a 40% LVR, a particular piece that we took to Judo absorbed, paid out the ATO debt and understood it was just a moment in time because they could look forward. So I think that those are examples that are important to articulate. But if you want details on lenders of last resort, there's plenty out there at the moment.
as the business matures, the market starts to understand a lot more of where our appetite sits, and knowing that coming to Judo is about finding the right solution to grow with their clients a lot of the time, rather than, I think to your point earlier, Dan, rather than looking back, it's about looking forward to growing with our customers, rather than a point in time. I don't know, Dan, did you want to add anything else on that question?
Yeah, I've got a lot to talk about, I suppose. Yeah, look, you just need you need a good solid bank to back you. Yeah, because like I said previously, it can cost you a lot of money, especially in the developing mind. And if you've got ambitions and and goals and legacies to leave to your family, it's Judo's. I'm so proud of being introduced to Judo because it's a bank that actually works with me, and I wish you were around 30 years ago because it would have saved a lot of heartache. And with the major fours, half of them will probably come to Judo in time.
Excellent.
And it's probably the other half of salesmen that want some
Excellent.
points on the board.
A question, yeah?
Thanks for coming in. How do you manage the sort of narrow product offer? You've got to have transaction accounts, you've got to deal in rates, FX, etc. Other banks will provide that. How do you manage the relationship with the other banks? And at some stage, I imagine they'll offer you a big prize to bundle everything up together.
So I have 4 businesses. I want to try before I buy. So I actually have my transaction accounting for my business banks with ANZ, CBA, NAB and Westpac. Just because I wanted to try. It was a horrible time when I had a home loan. But in terms of the product offering, I use cash flow lending, I use equipment finance, I use working capital facilities from Judo. But do I need a transaction account from Judo? Not necessarily. I think I've tried all the big 4 banks, transaction accounting, it's all very same. It doesn't make a big difference to me. FX anyway, I don't use big 4 because I ship a lot of goods in from Asia in US dollars and RMB. And if you're using big 4, you're going to get absolutely killed on the spread anyway. So for that anyway, I use FX brokerages. So the thing that I need for my business is debt to actually scale my business for working capital, equipment, new geographies, buying out my competitors. And that type of conversation of I want to go and buy my competitor, I want to expand into a new geography. That's something that's very easy with Judo. Versus I have a consolidated operating model that I have for all my companies, and my banker will actually go through it every 6 months and actually go through my holding company model, and he'll go through my financial model line by line and look at the drivers. And so that's what helps me get credit back with a positive, thumbs up for me to go out and have confidence to go out and buy other businesses. I don't even check with Judo before. Sometimes I commit to things now because I know that when I go to them, because I'm bankable and I'm sticking within the credit risk rating, they will probably underwrite it. And if I don't, then I've probably done something wrong. So in terms of transaction banking, I have transaction banking with all the big 4, but that's not really what drives my business.
Excellent. Faris?
Also, the rise of brokers in the commercial market is going to significantly change the model of consolidated lending. Clients come to us right now and we shop the client. So we take their transactional banking to the best transactional bank. If CBA is not paying them, interest on their cash, we take them to a bank that will pay them interest on their cash, and we almost broker that transactional piece of their portfolio to the best fitted bank. Then we go look at their FX and we take their FX to, whomever is going to give them the best spread and whomever is going to give them the best rate. Then we go take their debt to a bank like Judo. And the narrow product suite's narrow but still broad, really. Term debt is term debt wherever you go, and an overdraft or a line of credit is an overdraft or a line of credit. And apart from equipment finance, which they have a good product for, there's really not much else you need apart from maybe invoice debtor. But then if you structure the line of credit tight enough and your cash flow swings well, then you can almost manage your business with that product as well. So the product suite, it is narrow, but it's very manageable for SME clients. When you get to EC, a bit different. And I do think banks will start losing a lot of edge in terms of that consolidated banking, unless it's ASX or there's some sort of benefit in syndicating some sort of their portfolios. But in SME, my guys are actively shopping transactions and actively shopping what is best fit for client.
Yes.
Hi, thanks for coming and sharing your stories. For those that have had experience or difficulties with other banks, Did you feel like it was the bankers that didn't understand your business or credit, or was processes and policies in the background that they couldn't lend to you, or that you couldn't deal with them?
Maybe Dan, if you want to start.
Yeah, I just think the major fours are just, they've just got their set ways, and you just got to tick mum and dad boxes. And, with commercial lending, that's probably been the hardest money that, I've had to undertake over the years. For instance, we had 25% LVR, and with Mudgee Industrial Park, the couple of the major fours would not lend on the commercial lend to actually construct the big heavy industrial factories that we've actually built. They always had the comment, Dan, we'd love to help you, but the risk is too high because it's a commercial build, and once you get it all built and all tenanted out, then you come and see us, and then we'll look after you then. Well, that didn't fit well with me at that point in time. So it's been a sort of struggle over the years. I've owned Mudgee Industrial Park for 25 years, and we're nearly there. And and with Judo coming on, it's going to guarantee the whole completion of it. And it'd be great with Judo. I suppose when a project like that's actually completed, it creates a target for the major fours to come in and say, Dan, we're going to offer you this amount of interest, but at the same time, I'm a loyal guy, and I won't be doing anything unless I liaise with Judo. And I just hope, Judo in time can, less their rates to, to benefit the project.
Yep.
I'm hoping.
So on that question
Sorry about
around
that
on that question around bankers, Faris, you experience a whole vast array of bankers in the area you play. Would you like to add anything to that question?
So for context, volume-wise, the residential business that we have writes about $700 million a year of settlements per annum, and my commercial debt advisory business originates and settles $2.5 billion a year of credit across all of the major banks. The banks. The problem with the banks is it's extremely segmented, and that's what happens when you scale a business, right? You need to put SOPs in place, and you need to kind of almost take power away from the front line, and you need to invest into credit so that you can find efficiency in your balance sheet. And you can't empower your bankers, because then how do you grow them? And then you have risk, because your bankers are becoming brokers, and they want to work 2-3 days a week, and they want to make the same amount of money. So then how do you keep them incentivized, And so the problem with the banks is not that the banks don't want to do business, is that they've become so fractionalized in their frontline product offering across multiple different sectors that they simply can't sit in front of a human and have a human-to-human conversation, which is, what have you done in the last 2 years? Where are you today? Where do you want to go in the next 2 years? And how can we help you as a bank? And that's the problem. So, and then on the rate side of things, Judo, as it grew, it scaled, and it wrote the right rate for risk. And what it's done exceptionally well over the last 12 to 18 months is start building a bell curve into its interest rates, and is really doing a good job in retaining its clients to a point where we don't need to look at refinancing them out on the back of it, and where that interest premium, which is really up to 100 basis points, is justified because they can put the back leverage back into the client's balance sheet to allow them to scale and grow. So it's not that the banks aren't doing what they're doing. It's simply that they're not empowering the front line to be able to issue a term sheet on the spot.
And as they industrialise, they're losing a lot of that experience in bankers in the front line, which further exacerbates the issue. Whereas with us, and built the business from a blank canvas, we're only bringing on bankers with that experience and trying to build out the skill set, right?
The major banks are also trying to, and we've been in conversations with this, they're trying to do a broker direct-to-credit model, which means that my team can execute transactions straight to credit, which tells you that they're going to keep commoditizing this commercial lending space, which is fine. There's a place for that in the market. However, businessmen want relationships on the ground, and they want to talk to people, and they want people that they can trust, because they feel untrusted in the market, and they feel like they're always being hunted by somebody. If it's not the state revenue office, it's the ATO. If it's not the ATO, it's their employees. If it's not their employees, it's payroll tax. If it's not payroll tax, it's something else, it's a developer. It's all, they're being hunted all the time. And so for them, that's why they're happy to pay
Yeah.
spread on their interest rate, because they say, well, my capital partner is there to back me. And at the end of the day in Australia, good luck building anything with cash only.
Yeah, exactly.
It's impossible.
Excellent. Thank you, Faris. On bankers, Lou, has it been difficult in recruiting bankers in regional areas?
Not at all. We have been the recipients, I think, of exactly what these gentlemen have been talking about, is that bankers, they want to learn. They're hungry for knowledge. I was 21 years in banking and I was starting to feel like my skill set was not being valued and it was being eroded, and I just wasn't having the day-to-day contact because our portfolios were so big where we came from. Tom and I, we joined Judo at exactly the same day together last year, and we came from the same old shop, and we just felt that we'd got to a stage in a career that we were just missing out. And so, no, not at all. So I would get inquiries every week or more by bankers, and lots of good bankers. The part of that is that we're pretty special, the people that we have here and let walk through our door. We value teamwork, so don't bring single players here to Judo. It just isn't going to work. We sort of pile in and we get the job done when that job needs to get done. We are there's not even a degree removed from risk. We are so close to them. So I feel like at the majors that we felt distant from the credit decision maker. Can you imagine what the customer felt like? We talk to people every week about roles at Judo. So I would suspect zero problem across the nation.
Thank you, Lou. There's another question.
Thank you. I guess the last couple of answers touched on this, but Judo often talks about bringing on a customer to Judo customer and potentially losing them down the track when they more bankable by the big four. Is it fair to say, boiling it all down, that when you feel like you have a growth mindset in your businesses, Judo's a bit of a no-brainer, and that perhaps when businesses become more mature, the price becomes more important? Can you just touch on those? Is it the pain point really just the decision making and the speed of decisions around growth in your business?
Yes, growth needs speed, right? And so when somebody's going to buy a business or leverage up their business or needs a decision, Judo provides speed, and then they provide that capital certainty and potentially more leverage on EBITDA, leverage ratios along the transaction. As those businesses mature, which, to be honest with you, we've been in a market where not a lot of businesses have been allowed to mature, I'd say, over the last 3 to 4 years, apart from sort of very turbulent years in terms of, I'm talking about SME specifically. There is a point where they become potentially bankable, but it's interesting. You go to a client and you say, do you want me to now go take you to a major bank? And they say, yeah, that's fine. But then, and that childcare client's a perfect example. He is bankable, and on his debt load with 150 basis point spread, we're talking about a 7-figure saving. And he's turned around and said, yeah, let's go to a bank, but what happens when I want to go find the next childcare? I said, well, then maybe we take it to a non-bank lender and we go and try and find a different situation. But then if we calculate the additional cost that you'll be paying on that lender, maybe you just stay with Judo. And so there's this point where if they are continuing to grow, there is no other provider in the market, in SME at least, or debt loads up to, say, 75 mil. There's no one else to go to in the market, and I can speak from experience.
I think it's also really important to note that price is just one factor. You're looking at quantum, you're looking at covenants, you're looking at the counterparty, and when I'm looking to grow, I'm sure Dan would think the same thing, but in your business, if you're looking to shave, 75 basis points off the debt, when you're underwriting growth options, you're looking at a 20% hurdle rate at least internally in a business. So if that's what you're trading off, 75 basis points, like I should just pack up my stuff and go home. And so price is not the most important consideration. Someone who can do it over and over again in different structures, and exactly what's the next option. Big Four, I could go refinance tomorrow and save, as I've got, coming up on $10 million of debt. Obviously, 100 basis points is a lot of money personally to an entrepreneur, but what about the next thing? And so I think it would be incredibly short-termist to look at just price.
Yeah, excellent. What did you want to
Yeah, I think if you've got the points on the board with Judo, the money, yes, it is more expensive, but hindsight, it's cheap. The flexibility when they give you a sort of line of credit, and the trust starts from day one. And if they trust you to spend that money wisely and invest, because I'm one, every bit of money I've got, I invest in my Mudgee Industrial Park to give me a return and an asset at the end of the day. I strongly believe Judo will be the superpower lender above the major fours in years to come.
Yeah, absolutely.
Dan.
Yeah.
There was a question at the front here. Sorry.
Yeah, that's right, John. No one does want to give me the mic. I had 3 questions, very mechanical. Army, first one. I've got a sneaking suspicion you're not the normal profile of a borrower. You don't often hear people talking about EBITDA that run plumbing businesses. Can I just find out, when you started out and you went to buy the second business, did they make you cross-collateralise, or was it done in a brand new vehicle?
So I've signed a personal guarantee from day one, and I've signed a personal guarantee on all the businesses. They're all under one holding company, and they have a GSA across everything. And I'll continue to do that over and over again. I'm not looking to ring fence assets or anything like that and have new lines. They are very open they always tell me, you structure it however you want to, and we'll just make sure we have the security on the back end to protect us. And they allow me, right now I'm doing an investment into backing someone else who's buying out a small business in the States, and that's under my holding company. And again, it's all collateralized under the holding company. So no, I haven't asked for separate ring fencing debt.
George, 2 questions for you.
Yep.
First one is, can you talk to us, you run the third party business, can you talk to us about the commission payments that go out the door? Can we find out upfront? Trail?
Yeah, it's fairly standard in terms of where market's at. So it's 0.6 upfront and a trailing commission of 0.3. And as noted earlier, we only partner with the top brokers in market. So part of that commission is for them to ensure they understand our risk appetite, where we play, and present a transaction to us that in 7-8 times out of 10 are deals that Judo will do one way or another. Structuring, to Faris's point earlier, working out what the right solution is for the client.
Okay. Final question, George. George, like I'm old, I remember those old John West ads. It's not the salmon, it's the salmon you reject that matters. Run the third party business. We've had a lot of stuff today about the belt system, which is all very impressive. Is there a rejection rate that we actually see Judo reject, or is it everyone works within their delegated authority and it's the banker that ends up rejecting?
It's a collaborative approach. If it's a banker that sits on a lower end of the scale or top, they'll engage with a banker that sits up higher. They sit in a pod structure, as Jess mentioned earlier, and they will collaborate and work through what that solution is. In terms of rejection rate, as I said, it's the stats that we're working off at the moment are around 7-8 deals out of 10 where we're saying yes one way or another, if it's in the way it's been presented or if it's around discussing, structuring, working through a solution that best suits the client needs.
So, so the banker's got the delegated authority, say up to $10 million, but that still needs to be approved centrally?
No. I'm saying if they sat lower down the belt level, but if they sat higher, then they've got the discretion. They will work with either their colleagues or with our risk partners to ensure that there is a consistent approach to what they're looking at and what they're approving. But ultimately, it's their discretion in market and ensuring they're bringing the right clients to Judo.
That's great, thank you.
No worries at all.
And just for reference, 40% of our loans, statistically, 41% to be exact, that get put up to Judo from email to presentation aren't accepted by Judo. So I think there's a lot of conversation here about backing new businesses and startups and ventures and taking on risk where there's not, where others won't take on risk. I can tell you independently, they don't take on all risk.
No.
Right? They take on, in my business, 41% of transactions that are presented aren't taken up the line. We're lucky, we write volume, so we know all the black belts, or the belt, whatever are they called belts now? Black belts, right?
Yeah.
And they have discretion, and we know what they'll take, what they won't take. Are they going to take a 60% first mortgage deal on some sort of residual stock? Yes, they will. Are they going to take a fully secured business loan? Yes, they will. Are they going to take a startup that's not presented to the sophistication that he's not a normal Judo client? No, they're not. So they don't write risk. That's not just issuing term sheets for the sake of it. And actually what they do very well is they don't issue a term sheet unless they meet the client face to face.
Correct.
Whereas I can go get a term sheet from NAB tomorrow without the banker meeting the client.
One last question up the back.
Good morning. Got a question for Faris. Frank said earlier that they're about to roll out a new business online savings account. What proportion of your customers do you think would be interested in that type of product? Is there a big need for it? And what sort of terms and conditions and rates do you think Judo needs to apply to that online savings account for it to get meaningful take-up?
I'm yet to see the product in full, but the clients that would benefit from those are the disciplined clients who would make $100, put $20 in the bank account to the side to pay the ATO, and would normally either put that money in a redraw or would put their money in a line of credit or would put that money sitting on the side. I assume the product would be, I don't know, what's the pricing on it? 3, 4, 5% sort of at cash, call it. It would just be clients who want to park their ATO cash whilst they're waiting to pay for their whatever comes due, PAYG, PAYGI. It'd have to be money at call on, say, 60, 90 days, but maybe some particular lockups for longer term parts of capital. And then pricing would have to be at cash or within 100 basis points of cash.
So just to follow up, I mean, Judo's talked a bit this morning about how big their TAM is in certain areas, deposits and funding. We've heard a lot about loans, but deposits and funding are pretty important to ensure that they can generate a decent return for shareholders.
Yeah.
Is there a lot of demand for this type of product, or is it going to be very, very niche?
There is demand. So there's two sides to it, you know. And I always have this running joke with Judo Bank: why would you be a bank if you're not going to take deposits? You know, because it's just too hard, right? But it's great that that product's rolling out. Just how I said before, where we're brokering clients, where they have transactional banking and where they have various different parts of their portfolio, subject to the product, it needs to be considered that there are clients who would deposit cash at Judo Bank in their business account that aren't that clients of Judo Bank if the product's structured correctly. And I think that that needs to be important. It's just like how we have investment clients who won't put money into our pooled fund, but they'll put money at Latrobe's pooled fund and they'll have money at call on 60 days, but they don't have any lending with Latrobe. So, and I keep comparing Judo to Latrobe, but for me, it's a very similar business going in a very similar direction, challenging very similar parts. So yes, there is demand. Clients sit on cash. A lot of clients sit on cash, and you may see emerging corporate clients actually leveraging off the product over time.
I've got $1 million sitting in ANZ. I should have talked to Faris. It just sits there interest free.
I'll get you 4%.
Excellent. Thank you very much for your time and honest feedback. Please join me in thanking our panellists. On that note, we'll take a morning tea break and be back in 20 minutes or so. Thank you.
Welcome back, everyone. I hope you enjoy hearing from our guest panellists, and I saw some of you bail them up during the morning tea break to keep the discussions going, which is fantastic. I never tire hearing from our customers, brokers and our bankers about the real impact that we're making in the SME sector and the communities we operate in. Stories like these are what has kept me in the banking industry for most of my career. For those of you that I haven't met yet, my name is Renee Roberts and I have been Judo's Chief Risk Officer since September last year, about 5 dog years. Joining Judo was natural for me, having always believed in what is our purpose, backing small and medium enterprises, and because Judo is one of the most capable, courageous and credible organisations I've encountered. I've worked in major banks and regulatory regimes across multiple geographies. Early in my career, I was a business banker, lending my first dollar back in the summer of '89. I have assessed credit, managed portfolios and dealt with challenging customers. Crucially, I wouldn't be here if I didn't believe Judo was match fit and poised for sustainable growth. As you heard from our panellists, Judo is meeting a need in the market, a bank that truly backs customers who are themselves courageous and building their future. All of my colleagues are here for the same reason. We believe in the sector, have worked in the big banks, and now feel like we are back doing what drew us to banking in the first place. Over the next 10 or so minutes, I will cover our risk management context, our approach to managing credit risk at a transaction level, and our credit risk approach at a portfolio level. The 3 key messages I want to leave you with on this slide is that we operate successfully in a broad and complex risk environment. A banking licence is important and is a privilege, and being APRA regulated is a good thing. It's a real benefit. It makes us domestically and internationally comparable, and it requires us to meet high standards. Judo stands out among Australian financial service companies. We are much smaller than our major competitors, and we see this as an advantage by the way we can be nimble when they are not, smarter and faster. We consider a banking licence to be a privilege and a responsibility. It enables us to take deposits and also meet rigorous high standards, something the non-banks are unable to do. Being APRA regulated sets us apart from the other smaller financial services companies that we're often compared to, including La Trobe. Being APRA regulated means that we must comply with over 50 prudential and reporting standards. To do this, we have built a robust risk management capability with a very experienced team of specialists. APRA is a regulator that is forward-looking, ensuring depositors can have confidence in the stability of the bank that they have trusted their money to. Indeed, in my previous life as APRA's head of banking supervision, we expected Judo to put all of the systems in place to ensure compliance with prudential, legal and social licence obligations. When I arrived here, it was really pleasing to see the depth of implementation of a sound risk management framework and then the resulting risk culture. We have achieved a significant amount in the 6 years since receiving our banking licence. We recently transitioned from APRA's new bank supervision team to the mid-tier team. Now, this is a major step and recognition of our development in size and complexity. And now we feel like the P-plates have truly come off. With everything that has been built here, our focus is now on optimisation, in contrast to many of our peers who are still modernising. You will hear from Raz next up about our technology journey and how well placed we are. But as far as risk management goes, we're also very well positioned to better use technology to optimise our policies, processes and systems to support Judo becoming even stronger, smarter and faster. Now, my remit as CRO includes the full spectrum of risks that Judo deals with as shown on this slide. We have a solid framework for managing each of the key risks and provide extensive reporting to management, board and regulators. Now, while all of these risks require diligent management, today I'm going to talk primarily about credit risk. It is our biggest risk. So we are in the business of lending money and taking risk, and that's what really it's all about. My job is not to say no, but to make sure that we are achieving an appropriate balance of risk-reward that will enable us to continue to grow a viable and sustainable business. All of us here at Judo, me included, are here because of the way we do things, especially our approach to lending. We have incredibly deep credit expertise. Across my credit team, we have an average of 23 years experience, totalling 837 years in total. We empower through judgment. We value credit expertise and we use that expertise. And our credit people meet customers. They go out and stand side by side with our bankers. The customer, and you heard it again earlier, the customer wants all of these things, especially they want a banker that is able to make decisions. Chris talked about Judo being built from a blank sheet of paper. This is incredibly powerful. Starting from scratch means we've been able to create a specialist business model built on several critical and strategically reinforcing elements, shown on the slide, with credit risk management at the heart of our business. These strategic elements, you may have seen something like this in previous slides and presentations from Judo. But what I really want to emphasise today is how important this is, and your takeaway should be how difficult this is to replicate. Our approach to transactional credit risk understands that every SME is unique and has different risks. Over my career, many attempts have been made to make SMEs homogenous. It doesn't work. As Frank discussed, assessing SME credit doesn't lend itself to automation or simplification. Understanding a customer's creditworthiness requires deep understanding of the business and the people running it. In this way, our approach to assessing credit is very similar to being bottom-up stock pickers. We rigorously apply the 4 C's of credit, of assessing credit: character, capacity, capital, and collateral to each borrower's application. Character is the first and most important aspect and includes a detailed assessment of a business owner's capability, evidence that they understand the risks of their own business, assessing their history of navigating business cycles, and their commitment to repay. Our customers, Army and Dan, who you just met, clearly demonstrate these character traits. Next is capacity or cash flow, which is understanding the drivers of earnings for a customer and their ability to repay. Historical financials are not enough. Next year will always look different, which is why industrialised processes don't work. Backward-looking ratios never tell the whole story. Customer-specific factors and changes to the operating environment mean that there is no substitute for understanding a customer's business. The third is capital. Understanding the point at which debt becomes equity and what a business needs to absorb a shock. Working this out is the true skill of a banker. Customers need to have their own capital, often referred to as skin in the game. Our job is to provide the debt. And then finally, collateral, or the second exit, if character, capacity and capital fail, which does happen. Most of the industry is obsessed with property collateral because, to Frank's point earlier, and also to Dan's point, they have de-skilled their workforces and lost the bankers who know how to assess credit. While the major banks say they are recruiting lots of business bankers, their overarching risk appetite still means that lending that they are doing is largely commoditised secured lending. Our bankers and credit execs can and do apply their judgment, which enables us to provide more tailored structures that better suit our customers' individual circumstances while also remaining within our risk appetite. Now, this doesn't mean that we just do unsecured lending. In fact, we have very, very high levels of property collateral against our loans. The difference is collateral is not the only thing we look at, nor is it what we rely on. The way we assess transactional credit is the way major banks used to assess credit before they began their process of industrialising. All we are doing is bringing back the skill of SME business banking. Next, and in my view, the most critical strategic element of our business model is technically capable and appropriately incentivised bankers. Jess has touched on this already. This is a major differentiator from the rest of the sector. Other banks have evolved into sales cultures, which necessitate segregated credit functions. By definition, bankers with sales targets must not have the authority to approve loans. The absence of sales targets and our ability to focus on recruiting bankers for their credit skills means that they can be trusted. We attract the most competent bankers in the market, we test them meticulously, we invest in their capability, and we empower them to make smart and faster decisions. Where a second set of eyes is required, our credit risk team is in market, sitting alongside our bankers, visiting customers, and ensuring our customers always have access to whomever is making the decision. This is why, as a matter of principle, we do not have individual sales targets. And the last point that I want to make in this set of strategically reinforcing elements is portfolio sizes. We have been astounded at how much a customer needs to borrow from a major bank before they have a dedicated relationship banker. Often it's at least $5 million and in some cases even more. We can over-index on banker numbers to provide a premium relationship-based service because we are not saddled with the same legacy costs our competitors have. Our target of 40 customers per banker at scale, 28 today, is a fraction of the industry average and will enable us to sustainably deliver our premium service, which also means we can remain close to customers and proactively manage emerging risks. To round out our approach to credit risk management, I want to briefly touch on our approach to banking through all parts of the cycle and how our strong approach to assessing and monitoring credit risk at a transactional level is complemented by our rigorous approach to monitoring credit risk at a portfolio level. On the previous slide, I covered the transactional level approach, And while correctly assessing risk at the point of origination is important, businesses are dynamic, and so it's just as important that we monitor and manage customers when they are on our books. Our low ratio of customers to bankers is key. Staying close to our customers and having regular contact means that we pick up early warning signs if and when there are issues. This allows us to do two things: offer support and advice in the very early stages, which might help a customer get back on track. And if a customer is facing an issue but is not being cooperative, we might reach the conclusion that they might be better off with another financier. There is often a window where this is very possible. So we have a good track record of seeing customers that have experienced some form of distress either return to performing or refinance. Unfortunately, there are also occasions when our customers' businesses are close to failing and or may have failed. So we have invested heavily in our asset management team, which consists of some of the most tenured people in the industry. We have 3 people in our asset management team with over 20 years asset management insolvency experience. And they're complemented by another 3 that have over 10, and they have 2 with over 5. This team does an extraordinary job of helping our customers in their most difficult times through what is often a very long process. Unlike a mortgage customer in distress where forbearance or foreclosure are the main options, given the nature of every business in trouble is different, the best course of action requires supreme judgment and care. While the bottom-up approach requires a lot of judgment, we also employ a top-down approach to managing the portfolio, which is more structured. We maintain strict risk appetite settings for sectors and geographies to avoid excessive concentration risks. The considered way that we entered agri and now warehousing demonstrates our prudent approach. Similarly, we've maintained our day one policy decision to avoid lending to greenfield construction. Our goal is to have a portfolio that mirrors the SME economy with good diversification. We are well on our way to this goal, but have some variances. We remain underweight in the agri sector, and it's unlikely that we'll match system for some time. We're also relatively underweight commercial property lending. This is because we made a proactive decision at the beginning of the interest rate cycle to increase interest rate buffers, require high interest coverage, and we've taken a conservative posture on valuations. Our commercial property portfolio is also different to other banks in that most borrowers are SMEs with strong alternative trading incomes or very healthy personal balance sheets. Importantly, though, we are never closed to any sector. We are less than 2% of the market, and we believe that there are winners and losers in every sector throughout the economic cycle. We supported businesses through COVID, including gyms and hospitality businesses. They have been fantastic, long-standing customers. Our sector appetites will change over time, but where a deal stacks up on character, capacity and capital, we will be happy to support it. And the last thing I want to talk about is how do we think about credit portfolio management and credit losses? So you're all familiar with our at-scale cost of risk metric, our 50 basis points. There is no consistent definition of SME among the banks, so good comparable data is hard to find. But based on the data available, the 30-year average for SME credit losses is around 29 basis points. We assume 50 basis points to be conservative. The 50 basis points is what we expect credit losses to be through the cycle, but we should expect periods where it's higher and periods that are lower. In terms of our P&L, we are required to provision upfront on new lending. So while we continue to grow, our P&L expense is likely to remain above the 50 basis points. The reason for this is what's known as seasoning. So we conservatively assess customers when they are new to bank. As they demonstrate a track record of business performance and repayment, their risk profile, ideally their probability of default, improves and we end up holding less provision. And that might be when Dan gets his discount. At scale, the P&L normalises. So In conclusion, Judo's risk foundations are very strong, comparable with any other bank. Optimising our approach further will support our path to scale. Now you will hear from Raz, who will talk about our technology journey. Thank you.
Good morning, everyone. My name is Raz Fornerino. I am Judo's COO. I joined Judo in July 2024 because I was in awe of the journey that Judo had been on and really excited about the journey Judo was about to go on. Prior to joining Judo, I had various senior roles across the Australian banks, including ANZ, NAB and MeBank, where I worked in both customer-facing and back-office operational roles. I started my career in 1982 when bankers were the backbone of the community and everything was paper-based. Banking has changed significantly over the last 40 years as technology has allowed us to do things more efficiently and differently. What has not changed, though, is the customer's desire to have a strong and lasting relationship with their bankers. My role at Judo is to ensure our bankers have everything they need to be able to deliver our relationship banking CVP for our people and our customers at scale. As a young bank, Judo has come a long way. Chris briefly touched on this. The task of building the bank from scratch was not for the faint-hearted. We made strategic decisions to focus on immediate priorities throughout our short history. In the build phase, our core objective was to prove the business case and reach profitability quickly. To do this, Judo kept our technology lean, relying on tactical, off-the-shelf solutions. The scale phase was about building future-ready foundational technology to support Judo's growth. That phase is now complete, and I'll talk a little bit more about that in the next slide. We are now firmly in optimise phase, with a clear plan to leverage our strong tech foundations to harness data and insights, using modern tools such as AI to empower our bankers and deliver on our CVP. I also want to remind everyone that Judo is early in our journey. Completing the build phase and scale phase in 8 years is no small feat. It's a testament to Judo's strength and agility. In 2023, we told you we would build for scale and continue to invest in existing capabilities. Since then, I'm pleased to report that our replatforming is behind us. As Chris mentioned, over the past 3 years, we've successfully delivered a significant change program to replatform our bank, one that any bank in Australia and in fact the world would be envious of and would find extremely hard to replicate. Just this month, we've successfully completed phase 2 of Judo's core banking transformation journey, building on the strong foundation established in our initial go live in mid-2024. This ambitious project, which kicked off in July last year, was complex and high demanding and demanded a relentless effort from all of our team. Over the period of 7 months, we designed, built and migrated our deposit products covering direct and intermediate channels across retail, business and security-linked accounts. In total, around 63,000 accounts were successfully migrated, marking a major milestone in Judo's broader program of modernisation. All core products, lending and term deposits are now live on Thought Machine. This strategic shift enables the bank to significantly improve operational efficiency, reduce technical debt and accelerate time to market for future innovations. Additionally, we've implemented Oracle's General Ledger and Enterprise Resource Planning system to support corporate operations and deployed a market-leading credit risk engine from Moody's to enhance risk assessment efficiency. With these foundational investments completed, Judo is now set to scale. Judo is a simpler bank today. Our technology platform is the benchmark that other incumbent banks are investing heavily to achieve. We have a flexible technology stack which reduces operational risk and lowers ongoing maintenance costs. This flexibility means we can respond quickly, ensuring our systems remain robust and efficient. With our native cloud architecture, integration and expansion is easier. This enables us to expand our capabilities easily as our needs grow. We also utilise best-in-class SaaS providers, which allows us to streamline upgrades and adopt innovation easier and quicker. This strategic combination allows us to embrace change quickly, enhance our service offerings, and deliver exceptional services to our customers. As Frank mentioned earlier, we are developing 2 new deposit products. With our deposits now on Thought Machine, we have the flexibility to build, test, and bring new products to customers in just over 12 months. This will take incumbent banks years to do. Our plan going forward is simple. Understand what is stopping our bankers from spending more time with their customers, then eliminate, streamline, or automate those processes. Our bankers today have on average 28 customers, although some have up to 50, but the average is around 28. With the technology changes we have planned, we can deliver significant efficiencies and create additional capacity, so bankers, in theory, should be able to maintain larger portfolios. Our near-term priorities are to focus on a range of initiatives to create capacity and increase the productivity of our bankers. Essentially, the plan is to supercharge banker productivity. Initially, we will implement a new process for how bankers complete margin changes. Today, our bankers spend on average 30 minutes on each margin change. The new process, which is currently being tested and will be rolled out before the end of this month, will take this process down to 2 minutes, giving bankers significant time. Other initiatives on the slate include digitising customer documentation and making documents available to customers for signing through the Judo customer portal, the ability to ingest data and information from third-party sites such as Equifax and Creditor Watch and populate our origination platform, eliminating the need for our bankers to do that, simplifying and streamlining the way we perform annual reviews, and rewiring our discharges process, our loan modification process, our loan structuring process, and our variation process, and a range of other initiatives and activities so that we can empower our bankers to deliver on Judo's CVP, smarter risk assessment, faster decisions, and stronger relationships. We are also thinking about what other technology investments we need to make to augment our existing capabilities. The most obvious of these is AI, specifically Gen AI and Agentic AI. Gen AI and Agentic AI provides us with significant opportunities to uplift the customer experience and simplify our core operational processes. There is no lack of information, research, case studies regarding AI, and our existing vendors and partners are falling over themselves to showcase their capabilities in this space. All are keen to work with Judo because of our modern technology stack and our proven agile approach. However, we must take a considered and thoughtful approach to identifying the right business problems we want to solve with AI. The use of AI needs to be targeted and tied to improving the way our bankers are able to more effectively engage with our customers. We have started on our AI journey and are testing different capabilities against known banker problems. For example, completing a credit memorandum in most banks can take bankers days, including downloading external PDFs, interpreting complex financial and legal data, and re-entering findings into core systems. This results in inefficiencies, risk of errors, and delays in loan assessment and approval processes. We have developed and are trialling a working proof of concept that will automate data integration from external providers to Judo systems, extract and categorise transaction-level data and flag revenue or expense anomalies from bank statements, provide a draft credit memorandum based on Judo's requirements, and conduct compliance checks against Judo policies to ensure lending is within Judo compliance tolerances. This is all done whilst ensuring there is a banker in the loop to verify and edit. Our focus in all of this is to create capacity to allow our bankers to spend more time with their customers so that they are able to deliver against our CVP of smarter, faster, stronger. Thank you, and I'll hand over to Andrew Leslie.
Thank you, Res, and good morning, everyone. For those I haven't met, my name is Andrew Leslie, Judo's Chief Financial Officer. And I joined Judo back in 2019 when the loan book was, and I remember this, it was a mighty $640 million. And it's been amazing to see the customer base and the business grow over the last 6 years. We provided a Q3 trading update and revised guidance to the market on the 1st of May. And so what I wanted to do today was to take the opportunity to step back a little and discuss two of the key drivers of our ROE at scale. Namely, the overall drivers of our net interest margin and the key factors impacting our operating expenses going forward. I'll then spend a moment to pull together some of the initiatives my colleagues have spoken to and how all of these drive operating leverage. So let's start firstly with NIM. Now, NIM for us is a very different story compared to the rest of the banking sector. Firstly, we are a pure play SME lender, differentiating on service, structure and speed. We are not a mortgage bank operating in a highly commoditised and competitive environment. Secondly, we do not rely on transaction accounts for funding, so we are not going to experience NIM compression in the same way that every other bank is now facing in a falling rate environment. And thirdly, we are still growing to scale with all the benefits this brings, including improved wholesale funding options and liquidity management. On the left-hand side of the page you can see here, we outline our medium-term NIM drivers, and as you can see, we have many levers here. Starting first with lending. Our loan book takes several years to turn over, and as a consequence, the benefits from front book lending margins in the mid-fours is taking a few years to wash through, demonstrated by the gradual increase in our blended lending margin. Now, front book margins from our core business will be partly offset as we expand into warehouse lending. This is high ROE business for us, so it's something that makes sense for us to pursue. But it does come with a slight drag on NIM, with margins closer to 4%. Next, on the funding side, we will continue to see tailwinds from funding supported by several factors. First, a higher mix of deposits, which is our cheapest source of funding. Second, the introduction of savings accounts, which provide us with diversification and funding cost benefits over time. And lastly, some further optimisation of wholesale funding. In addition, we'll see some further benefits from tighter liquidity management with minimal impacts in the medium term from our replicating portfolio. Our guidance, as you all know, is for an exit NIM in June 2025 of 3%. Now, this will represent a close to 40 basis point increase since June 2024. We're getting very close to achieving our at-scale NIM of above 3%, with the simple maths for this on the right-hand side of the slide. I do want to spend a moment now to unpack the movements in our lending margins, which are a key driver of our NIM trajectory. In the past 12 to 18 months or so, we've had greater focus on balancing growth and economics, ensuring that our lending margins appropriately reflect our service premium, funding costs, and risk. On this chart, you can see the improvements we've delivered here over the past 2 years. And as a result of this shift, our blended lending margin is now sitting at 4.3%, compared to the 4% level the book was generating back in June 2023. Now, a reminder that front book margins can move around somewhat due to lending mix and market dynamics. For example, larger loans at lower margins, or agri loans, which are typically at slightly higher margins. On this chart, you can see the typical spread of margins across the book. We don't take a one-size-fits-all approach, and we seek to price appropriately for each customer and situation. The improvements in margins you can see on the chart are a key driver of our NIM trajectory and are a result of the focus we've had on balancing the overall economics of the portfolio. Let's spend a moment now on our funding strategy, which is another key driver of NIM. There are a number of components to this strategy which we continue to optimise as we scale. Firstly is the ongoing growth in our deposit book as we progress towards our at-scale target of 75% of total funding from deposits. Deposits are our cheapest form of funding, so more deposits in the funding stack equals a lower overall cost of funding. Secondly, product mix. Today, deposit funding is derived solely from term deposits. But with a TD book of now well over 9 billion and a rollover rate of 70%, we are now actively working on a savings account offering, as you've heard. This will help reduce our reliance on TDs and give us the flexibility to optimise flows and reduce overall deposit costs. We had a question on this earlier. This is more around how we manage the book rather than a cross-sell play. In addition, now that we are on our new deposit core banking platform, we are considering other investments and refinements to our TD offering to increase capability and flexibility. Outside of deposits, there are a number of other opportunities available to enhance our funding strategy. This includes ongoing optimisation of warehouse funding, continued presence in public debt markets, and other funding and ROE initiatives such as loan sales. Overall, the funding strategy has been designed to help the bank scale, maintain diversification and flexibility, and improve overall funding costs and economics. Next to costs. As you've heard, the foundations for our bank are now built. Non-customer facing roles are reaching maturity, and amortisation from past CapEx is now largely in the cost base, with annual CapEx more stable going forward. We are also a simple business with no legacy agenda, as you've heard from Chris and Raz. We have a simple, focused product set and business model. Simplicity helps keep our costs low and our investment slate efficient. Going forward, cost growth will be much more leveraged to revenue growth. For FY26, we've previously flagged some wage inflation expected for customer-facing roles. In addition, we'll be making some further investments in the front line, including hiring of new bankers and frontline staff, banker upskilling, and banker enablement. Overall, we expect to see positive CTI progress for FY26, supporting our operating leverage trajectory. One of the most compelling parts of our story in the near term is this significant operating leverage we have in the business. Operating leverage for us is multifaceted. Hopefully you have been listening to my colleagues today because it combines all of the things that we've been running through across this morning. And I want to spend a moment here just to sum up the initiatives we've discussed to show you how they drive operating leverage. So firstly, we have an expanding TAM, as Frank spoke about. We're growing our geographic footprint in the regions and we're adding more bankers. Second, we're growing our market share with above system lending growth in our core business, given our unique CVP and our modest market share to date, our differentiated approach to the broker market, and you heard Faris talk about that earlier, and enhancements to existing products. Thirdly, we are delivering very solid NIM expansion, or price growth, I guess, for some of the generalists in the room. This dynamic is supported by multiple factors, including our disciplined approach to pricing for risk, the evolution of our funding stack, including enhancements to our existing TD product, as well as the introduction of the new savings account products, and tighter liquidity management. Fourth, we are generating additional revenue from our new warehouse business, and we expect to generate more other operating income from new products over time. And last, as I covered on the previous slide, cost growth going forward will be more moderate. We have a simple and focused business model which helps keep our costs low with significant leverage from our existing investments in people and systems. So all these factors contribute to significantly positive revenue to cost jaws over the near term, driving the strong profit trajectory we've highlighted in our PBT growth guidance for FY26. And as you can see from this chart, we are on the cusp of significant operating leverage over the near term, which is further highlighted when backing out the contribution of the term funding facility from the past couple of years, which supported higher headline profit. Thanks again, folks, and I'll now hand back to Chris.
Thanks, Andrew. And look, I'm going to start my conclusion with the slide I've used consistently since my appointment as CEO, the service profit chain. As CEO, I really am passionate about this model. I deeply believe highly engaged employees provide great service for customers. Those customers tell other customers, and this in turn delivers great results for our shareholders. And as Jess said, our JEDI correlation data proves this relationship exists. I truly believe our culture is our secret sauce, and having built Judo from a blank piece of paper, we've had the incredible opportunity to build the company that we've always wanted to work for. I started my presentation talking about the lack of legacy. While no legacy tech, systems and processes are key, by far the most important factor has been no legacy people. We've been able to recruit people passionate about our purpose and are experts in their field across all parts of the business. Most importantly, for our customer value proposition, we have amongst the best relationship bankers in the country who are empowered to build enduring relationships with their customers. Hopefully, it's obvious that as we continue to satisfy customers like Faris, Dan and Army, we can continue to grow and deliver strong results. Hopefully, it's also clear that we have an executive team that knows how to run a business bank and are passionate about Judo and the opportunity in front of us. Our key business metrics at scale are the financial outcome of everything we've discussed today. We provided these metrics at the time of our IPO, and they continue to be our binding contract with the market in terms of our financial aspirations. We're proud of our growth to date, and of course, we still only have 1.5% market share. We're not far away from our at-scale GLA target of between 15 and 20 billion, and the continued expansion of the TAM, we certainly do not see 20 billion as the end point for our loan book growth. We are funding ourselves largely with deposits, which, as Renee said, is the holy grail of being a bank. We have built a $10 billion deposit book with a single TD product, and as Frank set out, we are now taking our first step of diversifying our deposit base with a savings account. Along with our maturing wholesale funding program, this will lower our cost of funds and improve our funding diversity as set out by Andrew. This lower cost of funds can either then be passed through to the NIM, or it can enable us to access more of the TAM with a lower gross margin expectation. Costs, as Andrew talked about, are now benefiting from scale, and from here our investments will be completely growth focused. And as Jess said, we are the preeminent destination for SME bankers. We have absolutely no issues at all attracting the talent that we need to keep growing our loan book. In addition, the investments RAS is making will give bankers more capacity to deliver our CVP. Renee's covered our approach to credit risk and how all the different elements of our model help us manage risk, both bottom up and top down. Because as a bank, we are in the business of assessing risk, which is why we recruit and reward our team based on their risk capability. Frank's explanation of the types of risk we take should also give you comfort that the lending we are doing is no different to what the major banks were doing 20 years ago. But as our panel said, they simply can no longer do it. And the sum of all these components is a target ROE in the low to mid-teens. You know, FY26 is an important year for our ROE trajectory and shows that we have a clear pathway to achieving sector-leading returns. So in closing, we're proud of what we've built and know that our model is impossible to replicate. To build what we've built with our unique culture and business model is only possible when you start with a blank piece of paper. However, it's not for the faint-hearted, and it's hard to see how another Judo will ever be built because so many stars need to align to get as far as we have. We've navigated a significant amount of complexity to turn our vision of 10 years ago into a reality. But with the build chapter now complete, we've reached a threshold point in our journey where we can focus on what's next and how we can optimize and achieve our vision of being world-class. We love talking about Judo, and I know I speak on behalf of the team when I say it's been a privilege to have your attention here this morning. I'll now invite my exco to the chairs here, and we'll look forward to answering any of your questions. And then it's a wrap, and we'll invite you to join us for some lunch. Thank you. And Andrew, you're going to facilitate asking questions? Yeah. By Jason, who runs our agribusiness, Ben, who runs our core business around all the states, and obviously you've already met George, and I'll divert any questions as appropriate to Ben, Jason, and George.
Thank you, Chris. So we do have roving mics, and so please just put your hand up if you have a question. We'll take our first question from John Mott.
John Mott from Barrenjoey. A question. If you think about it, the journey since the IPO from a stock market perspective, the one area that we've been consistently disappointed with has actually been credit growth volumes, where we've consistently seen it miss where we thought it was going to get to, and we've consistently downgraded our forecast. It's taken longer to get to that at scale than we thought. Now, when we look at it and we speak to people out there, it really turns out that you're really a transaction bank when you have customers come to you at a transaction stage, whether it's Dan or the other guys who are up on stage before. And what we're then finding is that they're getting to a stage where they've finished that transaction and then they're rolling off either to another bank or refinancing or asking for that Dan's discount, as we're all going to be talking about. And therefore, either you've got to sacrifice margins and the scale is the economics aren't as good, or the growth doesn't come through. How do we think about this, especially given that you're now writing 75% of the flow through broker? Originally, it was a 50% target, as you mentioned before, and the brokers are actively incentivised when their customers are coming towards that phase to ask for a discount or refinance externally. And does that really put the economics at scale at question?
Yeah, no, look, it's a great question, John. I mean, obviously, the IPO was pre-COVID, and COVID did change some of the original assumptions that we had. I mean, the way that we think about growth at the moment, I think I took you through these building blocks when we last spoke on the trading update, is if you think about an average loan size of what it is, about $2.5 million, and we have 160 bankers. But 2.5, and we have a banker originate one loan, just one loan per month. Then put that into your spreadsheet, and you'll see we should easily get $5 billion of growth, or $5 billion of gross originations. The runoff of the book, we believe through the cycle is about 20%. So on a $12 billion book, that's rolling off at $2.5 billion. So 5 minus 2.5 is $2.5 billion of growth, which is, and we always say that we think about our growth between $2 and $3 billion. It has generally oscillated between 2 and 3, and runoff has been elevated in the last year, as you know, and that is why we downgraded by $300 million 3 weeks ago. It was purely because of elevated runoff. It wasn't about gross originations. So you're absolutely right. Our CVP really connects well with customers when they want to do a transaction. We are a transaction bank. We don't generally do straight refinancing from a major bank. It's pretty much non-existent. There's always a trigger. The customer wants something. Maybe they want their house back that they provided as security 4 years ago, and now they don't think they need to do that anymore. But there's generally an underlying transaction. I think for us, as we bed down the relationship proposition, it's getting the margin expectation, as you heard from our guests earlier, because they value that we'll be there for them in the future. When you build a bank from a blank piece of paper, it's hard to prove that your customer value proposition is real. We always said this, that we thought that our margin would increase over time because we establish a brand, And I think, Judo is well and truly arrived now. We have a $12 billion book. We have the best bankers in the market. Those bankers build established relationships with them. We're very strong in region, where relationships are even more entrenched in the regional areas and also in agriculture. And so we're always thinking about averages of averages, right? It's averages of averages in terms of our margin expectations. It's averages of averages in terms of average loan size. But I think as our business grows and matures, we will be able to manage the margin expectation and the growth expectation that underpin metrics at scale. In the past, we've generally had to trade. We've sort of traded one off against the other in the early stages, particularly during COVID. And I think what happened during the COVID era, and I think Renee talked about this with regards to the way the banks didn't support businesses that were reliant on heavy footfall, particularly hospitality, gyms, etc. We did a lot of loans during COVID. In fact, if you look at the APRA stats between March 2020 and March 2021 for the big four banks, you'll see they went backwards. The system actually shrank. And we doubled the size of our balance sheet. We went from that 600 million that you talked about, Andrew, to nearly 2.5 billion during COVID. And a lot of those loans were, if we're being honest, they probably were a little bit more commoditized in nature than the original thesis. They weren't quite they were only in the half moon because of the COVID event, where the rear view mirror just didn't work. I mean, during COVID, you can't originate with a rear view mirror. The rear view mirror meant nothing anymore. You had to be able to assess forward looking. And we were able to do that. But now, and we were able to do that at a lower margin expectation than we currently have because we had the term funding facility. Today, our funding costs have normalised. We have a higher margin expectation. The banks have fallen back in love with SME. COVID is behind us. They're now relending to some of those customers, and some of them we're just happy to let them leave. So we have seen runoff a little bit elevated, as you know, and that's been the difference between the growth that we originally signalled. But fundamentally, we believe that we can grow our book between $2 and $3 billion for the next 2 or 3 years to get to that $20 billion outer market of metrics at scale at the NIM expectation that we've flagged. Yes, we do. Yeah.
So just following up on that last point, you said there was a whole lot of loans written during COVID. So it's now, let's just say as you came out of that 3 years ago, you're seeing an elevated runoff rate than you thought, not the 5-year, but it's faster than that. So the book duration is shorter. So you've got to pedal a lot faster on the front book to grow that book. Are we going through a period now where you're just running off a lot of the hump that went through during COVID, or are we actually in a stage now where the duration of the book isn't 5 years, it's 4 years or 3 years? Because if that's the case, the economics totally change.
No, we're happy with the 20% runoff.
So we're just going through a hump of COVID customers, and you're comfortable that once we're most of the way through, how much further should we see before we actually start to see the book accelerate?
And a lot of it was the system lowered the price of credit with the term funding facility, we believe between 50 and 100 basis points. The whole system did. We were caught up in that. And that's when you'll remember, I think it was the August 23 results when we published a NIM of 3.5, but we had a gross margin of 4, not 4.5, but we had a weighted average cost of funding of 30 basis points, not 1. So the maths was different. Now that deposits have gone up to sort of the 80, 90 basis points, we are getting our 4.6. We're not chasing growth for the sake of growth. As I said, the economics need to work for us as well. So a lot of it has just been transitionary as we've come off the COVID era. The term funding facility has been repaid. But today, as we stand here today, we originate at 4.6. Our average cost of funding is 1%, as Andrew said, and we're happy with the NIM guidance that we've given over 3. We'll have an exit NIM of over 3, and we think of growth going forward between $2 and $3 billion a year.
Good morning, Matthew Wilson, Jarden. Perhaps a question for Renee and Andrew sort of combined. Renee, you've spent some time at APRA. Just to draw upon the net interest margin chart, there's an optimisation opportunity as you move from MLH to LCR. Could you talk to that, give us some colour of what that journey sort of looks like, a time frame, and the potential upside to margin? And I have a second question.
Well, maybe I'll start. Thanks, Matt. I mean, yes, we've talked about this over a while now, that we, as a new bank, started, with all of the training wheels, P plates, across, all of our settings, capital, liquidity, etc. So for us, this has been a bit of a journey in terms of the liquidity that we're operating at. And COVID and the TFF, another distortion of that. I mean, it was a good thing to have the TFF, but another distortion of that is obviously what it did to our liquidity, because we had to hold, MLH on top of the, the whole TFF allocation. So we've been managing that down. You can see that with how we've been running the MLH levels, and also the actual dollar levels of liquids across the book. So it's a long way of saying this is a bit of a journey for us. And we are on the journey in terms of how we are operating and the liquidity levels that we need to operate at. We've been managing that liquids book more tighter over the this last 12 months, and we're also getting a better yield on that liquids book. We took some liquids on that when rates were very low. We brought a bit of yield forward at that time. Those things are not earning very much at all. They're maturing, and we're rolling them at things closer to the cash rate. So, but for us, the journey in terms of liquidity is one where, as we demonstrate our ability to operate the bank effectively, to manage to our liquidity settings with the appropriate frameworks, and Renee will be able to add to this. We think that we've got the ability to operate that tighter and more effectively. And that's been a bit of a journey again for us this year with the TFF gone, just demonstrating that, and that is part of the overall liquidity journey for us. Whether it's MLH or LCR or whatever the regime is, there's a bit of a way I think for us to go, and that's through us demonstrating how we can manage those levels. But Renee, you'll have perspectives too on this.
Yeah, thanks, Andrew, and thanks, Matt, for the question. Look, I think it is interesting because we work very closely with APRA, obviously, and when you transition from the new bank regime, which is an odd regime because there isn't really prudential standards that govern it, so you end up with certain metrics and you need to sort of level set them. So we're still in that process of level setting those, even with MLH. So we're certainly working with APRA to mature that and be better at it in their eyes as well. But there's a bit of a threshold that they look at, which is when you're a SFI or a non-SFI, and that's at that 20 billion asset threshold. So we're on our way there. So we will need to start thinking about how we sort of transition away from an MLH regime into something more mature, around probably the 17 million as we start moving to 20, and then even then there's a transition period. So, and APRA do talk to us all the time about you need to start thinking about what you're going to look like when you're an SFI as opposed to a non-SFI. So it's on the radar, not for next year, probably not the year after, but there or thereabouts.
I think it's fair to say though our liquidity holdings are only going in one direction.
Yeah, and that's that's because we've done the shadow calcs obviously as part of being prepared, and our shadow LCR is very high, as you would expect, because we're just a TD deposit book today. Now, even with the introduction of some savings accounts, I think we've got a structural advantage there in terms of just pure liquidity metrics, because we don't, as I said, don't rely on that huge kind of transaction funding element that most other banks do. So, but this is about us maturing. It's about us demonstrating the ability to to operate it and operate effectively. But certainly, yeah, when you do the raw calcs, we've got a high shadow LCR.
And then a question on your black belt bankers. You've got 159 bankers today. How many are black belt? How long does it take to become a black belt? And then once you're at scale, 200 bankers, how many black belts do you need in that model to hit all those scale metrics?
Frank, do you want to take that?
thanks for the question. And it's an interesting, because I might give a bit more colour to the black belt scheme actually, because it's quite unique even at an industry level. Because when a banker transitions into black belt, as well as getting the higher discretion, what we also trust them with is a slightly different process for how they think about credit and credit risk. Because if you think about what the primary role of a banker is, in the first instance, it's to understand at what point debt risk becomes equity risk. And so at what point of leverage on a particular asset or on the underlying assets that we're lending against us. And so the black belts actually have more discretion in being able to determine that outside of an LVR framework, which is commonplace in the rest of the industry. So if you think about a commercial property that the rest of the industry determines debt risk becomes equity risk at 70%, because that's typically where the LVR regimes start and finish. We give those bankers a bit more flexibility to take into account the wealth of the sponsor, the quality of the tenant, whether it's an A or a B grade asset, what the location is, what the whale is, all that sort of thing. And so in addition to the discretion, they get a little bit more flexibility to determine the policy measures that sit behind and the structure of the transaction. So that's a long-winded way of saying today we don't have heaps. It's less than 20 black belt bankers, but we do have internal programs that are about upskilling from a capability point of view to have that increase materially over the next 2 to 3 years. We would hope to have more than 50% of our population in the next couple of years that would sit in that framework.
Thank you.
I think one of the things that I think Jess touched on it. I mean, one of the bits of the thesis back in 2016 that I think we underestimated was the degree of de-skilling that has occurred. This 50% pass rate on the credit exam, is pretty depressing. And so, the original thesis back in 2016 we would have 100% black belts. I mean, black belt is basically judo. But also, how do you get a banking license? You don't start by telling APRA you're going to have 160 black belts. So there's a journey that we've had to go on in terms of the type of bankers we've been recruiting, truly understanding their credit skills, what development needs they might need. We have a great apprenticeship program inside Judo. So one of the real successes of Judo has been the conversion of our analysts into bankers. We've got 60 analysts today, and when you're modelling, if you're thinking about how to model our cost base, 3 or 4 years out, you should, with all the work that Raz is doing, you should be thinking of those 60 analysts as bankers, with less than 60 analysts coming back in to backfill those roles, because we would have automated a lot of the roles that they do for us, which is a lot of the stuff that Raz touched on.
Yeah, so a question around wage inflation.
On the analyst to banker conversion, yeah, and the black belts.
Yeah, look, we've called out as part of what we said at the trading update last month, how we're thinking about investments for next year, and one of them is around kind of wage inflation for bankers. That is there's components to that. There is a component, a little bit of component around overall wage inflation for the banker population. But for us, there's also an element of this upskilling. So, the promotion to black belts. I mean, we've spoken about that, Jess and Frank, as earlier today. So that is an element in as how we think about what with the journey that we're now on. We've got a population there, but we want to keep investing in that population. And part of that is you'll see that in terms of the salary or wage inflation. But the big part is then the empowerment that gives the banker, what that means in terms of the service proposition. We're really doubling down on that through this program, and the ability to service the customer in a way that is very different from what and hopefully heard it from the panel in terms of how the rest of the sector operates. So. That is a good investment for us to make. We think that will have really good dividends in terms of the service proposition and just the efficiency then of the way that those bankers operate as black belts.
Thanks, Andrew Lyons from Jefferies. Andrew, maybe a question from
for you that's related to John's earlier question, but focusing more on the lending spread side of things as opposed to volumes. You're targeting mid-fours for your lending spreads. Now, when we look at RBA data and combine the sort of the lending done to small and medium enterprises by the industry, it sort of averages a spread of sort of between 2.5% and 3%. And even if we focus only small enterprises, it's like 3 to 3.5%. So I'm just wondering if you can perhaps at a very high level just help us to understand the gap between what the industry is charging, the RBA's definition of like small, medium enterprises, and your target, perhaps breaking it out by size, product, risk and service.
Yeah, look, I mean the stats are a bit unhelpful as it relates to our business because they are at the system level, and you know the system is the system. That works for some customers, and you've hopefully heard from the panel today what that means for our customers and who we target. The spread though, and we did provide a bit of information on the spread that we typically see. It's not a one size fits all. So we do price, at a customer level and a situation level across the book, and we do charge more for that service proposition. I mean, you heard on the panel today, but it varies by situation. So there's no kind of one set of numbers really in terms of where we benchmark versus system, but we don't compete on price, and I guess that's probably the key takeaway. When you try and reconcile our numbers, what we talk about in terms of our front book, what you're seeing in that blended lending margin, it's different to those RBA stats because it's a big system. It's a system that has been commoditised to focus on property, and we do a different type of lend, and we bring a different customer service proposition, and we charge for that.
Yeah, I mean, just to build on that. So again, averages of averages. So the range, we will have some customers borrowing at less than 2%, and we'll have some closer to 7%. So the average is about 4.5%. But as Andrew said, I mean, Faris would have told you if he's got a 60% loan to value, a deal with an established operator, 3 years great financial results, no speed bumps, no story, not in growth mode, doesn't want anything interesting, he's not going to bring it to us, right? I mean, the big banks will just fight over that every day of the week, and I think, as Andrew said, the system margin reflects the system. And I'll remind you of the half moon, sort of diagram that we gave earlier. That's not the lending that we're doing. We're doing the lending that banks used to do, that was bread and butter 20 years ago, but unfortunately today isn't, and we can get a better margin for that. Yeah, we did a lot of analysis on this back at the time of 2016 when we were designing the bank, and we found that it was up to about 100 basis points, and then over 100 basis points, customers decided that the price differential was too much. I think though, as I said earlier to John's question, as we're establishing our brand, we're establishing our customer value proposition, we're proving that we have better business bankers, we're proving that they can make decisions quickly, we're rolling out our black belt. People like Army, I honestly, within reason, because he can make a hell of a lot more, a better return than 100 basis points on whatever it is he wants to do next. And I think it's the certainty of knowing that we'll support our customers and we're there for them and that we can make a decision. So look, it's different for different customers, right? But we're certainly in confidence that we can get that 4.5%. But as I said earlier, a decision that we'll have to make is as we start to expand our deposit products, we start to bring down the weighted average cost of our deposits by having things like IOSA, BOSA. We will have a decision to make. Do we just pass that through to the NIM and have a higher NIM, which obviously translates to higher ROE, or do we use it to expand our TAM? So do we then say, well, if we can reduce the average weighted cost of deposits from between 80 and 90 to 50 basis points, do we drop our gross margin expectation from 4.5 to 4.2 and go after a bigger slice of some of those more commoditized deals? Or do we defend even stronger, John, the back book? Yeah. So those are decisions that are in front of us.
I think we have a question over here from Jeff.
Good afternoon. Question on outlook. On your FY26 target of 50% PBT growth, can you give a bit more colour on what you mean by stable economic conditions? And does a stable backdrop imply at least $2.5 billion of loan growth, which is the middle of your target?
I mean, all we mean by that is that there's no significant shock to the economy that we haven't got line of sight of. I mean, we think the economy's in good shape. We think the soft landing has happened. As I said, the economy is transitioning from a consumer-led economy of the last 2 decades, which has been a story of household leverage, to one of investment-led now from businesses. Interest rates are falling. That's great news for businesses. You know, consumers have got more to spend. So we're quite positive on the economy. All we meant by that was if there's some major shock, if there was another outbreak of COVID, or there was some significant rise in interest rates because of some dislocation around the world, then it was no more than that.
Got it. And then a quick question on TAM. If all goes well, what percentage of the agri lending TAM, or $39 billion, do you expect to capture within the next 1 to 3 years?
Well, I mean, Jason, why don't I pass to you? I mean, we're very underweight on agri at the moment. We made a decision on day one when we launched Judo. We decided not to go into the agricultural sector, largely because how do you build a bank from a PowerPoint presentation? You start in the capital cities. You don't start with a banker in Mackay or a banker in Orange. And so we built the business from the capital cities first. We have a rule that we won't lend to a customer that's more than 200 kilometres away from a banker. So again, that sort of constrained us initially with regards to starting in the capital cities. Now that we've been lending for 6 years, we do have a strong appetite to expand regionally. Our CVP connects much stronger there. That's with more entrenched relationships, as you heard from Dan earlier in his relationship with Lou. And we're significantly underweight. So it's about somewhere between 17 and 20% of the economy is agri, and we're 7% of our book is that. So we're massively underweight. But I mean, Jason, why don't you just talk to where we play, where the half moon is in the agricultural sector and how we win?
So you would have heard from Dan. So he's a real stereotypical kind of customer that we see in Judo Agri World. So like what he didn't really talk about was the fact that we funded him into quite a large farm as well, like a cattle farm. So, where we kind of win and where we differentiate ourselves across, compared to the majors is we take a holistic approach to customer assessment. So he's got the industrial sort of storage sheds and the commercial business that underpins the trade-up story of the cattle farm. So at a major bank, that would just blow their mind because they'd try and jam it into either the commercial segment or the agri segment, and each segment wouldn't know both parts of the business, if that makes sense. So, we continue to expand. We're still continuing to hire into new regions. We'll be 31 locations by the end of June, and continuing to expand that. So, plus we'll also be hiring more people into the existing locations to where we've the Judo proposition's landed really well, to continue to kind of expand that. So, I don't anticipate we'll get anywhere near system that 17 to 19% anytime soon, but we'll continue to expand and put people in the right locations.
It is a significant point of difference for us is that we can bank the customer and we can bank the regional town as opposed to you've got an agri banker and a commercial banker. I mean, we're not going to name it. You were telling me, Jason, about one competitor where an agri banker can literally not do a commercial loan because it's on a different system that they don't have access to.
Yeah, I've come out of a major bank myself, and sitting in the credit chain of a major, like you look at a transaction like a Dan, you'd just be swinging it over the fence to the commercial credit guy, to the agri credit guy, when underlying, if you have a banker like Lou and Tom sitting on the transaction who understand the group from a holistic perspective, from our perspective, that's a much stronger transaction. You've got diversified income streams, diversified asset bases, and a customer that works hard with an ability to repay through the commercial business and then through the trade up of the cattle business. So just understanding the business.
And so to Andy's question, how much is that worth? Is that worth 100 basis points or 150 basis points, 200 basis points?
And we have agreements with customers like Dan too that, once he hits milestones, we will revisit the pricing. But and playing the kind of bookends to what Chris was saying earlier, your onboard customers in the 5 to 7% margin range, ratchet them down as they hit milestones and protect them and keep them.
I think the agribusiness is an interesting one to draw some of the threads that we've talked about already, because you typically get a more loyal client base in the agri segment that places a higher value on our value proposition, is prepared to pay a higher margin, and then churns less. And so as agri becomes a greater proportion of the overall book, you can take that as a bit of a read through for where we think some of those metrics will go in the longer term also.
Yeah.
Take our next question from Andrew Triggs.
Thank you. Andrew Triggs from JP Morgan. A couple of questions, please. Just interested in the progress on your warehouse lending strategy. I think the last time you gave an update, there was only one exposure from memory, and just interested in the nature of that exposure, the learnings of so far on that journey. And I think you'd also spoken about it being a bit slower ramp up than expected. Why has that been the case, and what are the sort of the progress or the path from here? And then just the second question around the impact of rate cuts. Obviously, you've got partially hedged through the ITOC portfolio. Just keen to understand if there's any other distortions we should be aware of with respect to hedging of deposits or the yield on liquids.
Well, I'll start with the warehouse business, and then I'll pass to you, Andrew. So we've got our second customer now on the warehouse business, so that was good news. Our second customer settled last week. This business, the thesis around why we believe there was an opportunity to provide wholesale warehouse funding to the non-bank financial sector absolutely holds true. We've had no issues at all in generating demand. We've got a pipeline, not pipeline in the way that we defined the 1.9 billion. We have a very specific definition around that, but more of a pipeline of a full pipeline, which includes leads, etc., of well over $1 billion for warehouse lending. I think what's caught us a little bit off guard is the gestation period for a warehouse loan is longer than it is for an SME. We've always guided the market, the investors, to sort of a gestation period of about 3 months for an SME loan. I think with warehousing, it's probably closer to 6 months. The due diligence does take longer, obviously. We are lending to a non-bank that's against the underlying receivables. And what we do is we bring our skill set around understanding counterparty debt to their business, and we look at every single one of their receivables. So we don't just take it as a basket. We go in and we look at all of the receivables. And then, as you would expect, we look at all of the operational processes that support those in terms of how they originate those loans, how they service those loans, etc. The due diligence has been taking longer than we thought, and it's actually not on the credit side, it's actually on the operational side. And sometimes we give them feedback that we need their operational processes to improve, to meet the standards that we hold ourselves accountable to as an ADI. And actually a lot of that feedback has been welcomed by those customers because it's free due diligence for them. But it has just meant that it's taken us a little bit longer to pull those deals through the pipe. But as I said, our second customer is now on board, and we've got a steady stream of customers ready to settle. So very excited about that. It will be at a slightly lower gross margin. We've always flagged that. We sort of think about that more like a 4% gross margin business, but much higher ROE because the risk weight on these, our average risk weight, as you know, on our portfolio is about 80%. Whereas on these warehouse deals, with the right diversification and the right first loss taken by someone else, we can get the risk weights down to sort of 30%. So they're very, very accretive to ROE, but they may be a slight headwind on gross margin and hence NIM, which Andrew flagged earlier. Do you want to take the second question?
Yeah, and in terms of the interest rate
yeah.
component, yeah. So I mean, we run a balanced book. We have most of our equity hedged, but we have a portion that is unhedged, and that unhedged portion is in the kind of immediate term, exposed to rate movements. We have a portion also of our deposit book, especially the much shorter tenor, that's just not economic to hedge, so we leave that unhedged. We've also got obviously our asset finance book, which is fixed rate. So yeah, we provide and have provided in the past a bit of a sensitivity in terms of rate impact. It's kind of immediate term or near term in terms of the impact. It's factored into our NIM guidance, and hopefully you have a better understanding of the many levers that make up that NIM and the many components to that NIM trajectory that are quite positive for us. I think the other point on this is that we just have a very different and are facing a very different situation to the rest of the sector in terms of a falling rate environment, because we don't have those free transaction accounts, which is a big part of obviously system funding. We're all TD funded. We did not enjoy that tailwind on the way up, and we're not going to have to face that headwind on the way down. And so structurally, we think that we are relatively better placed, whether that be on the asset side, in terms of where banks will go to try and preserve NIM. It's very hard to do that in retail. It's very hard to do that at the sophisticated commercial end. But SME is a less price transparent, and so and that is all of our assets. On the liability side, TDs is also a place where the system tries to manage economics on the way down when you've got when you're facing a reduced spread from that from where you're lending and the interest when in a falling rate cycle versus transaction accounts. But because we pay for TDs, that's already kind of factored into how we think about our economics. So we think that we're relatively well placed, and this is something that'll be interesting to see how it plays out for the sector. Might take our next question from Ollie.
Sorry, hi, Oliver from E&P. Just on the private credit partnership, you didn't seem to say too much in the formal presentation. I mean, what does that actually entail?
Frank?
Who would own the client? Who would own the risk? Can you go into a little bit more detail on that?
Sure. So I can take that. So there's a couple of different components to it, and I suppose the background is this is an expanding part of the market. It's an expanding part of the market globally. We're probably slow followers from an Australian market point of view. It's somewhere around 10%. It's hard to get a firm grasp on what proportion of the system it is. In other jurisdictions like the US, it's sort of somewhere north of 50%, and in some jurisdictions within the US, it's materially north of that. So we think that this is a global trend that's going to continue in this market. And so our first thought is, rather than thinking of it as an overt competitor, because we don't really cross over, maybe at the end of our appetite, we start to see private credit start to compete with us on certain customer profiles. But the real opportunity is, how do we become the bank that partners with private credit? So warehouse funding is obviously one part of that, so we can provide the wholesale lines to enable leverage into the private credit funds. But there's other opportunities even at a transactional level. The nature of private credit funds is typically, because they're charging elevated margins, and they're generally funding customers through some sort of event. Mature businesses that end up in private credit have generally had an experience with something. They've lost a contract. They've had some sort of event or some sort of shock that has necessitated them to move outside the traditional banking system and into private credit. Typically, once they're rehabilitated, for want of a better phrase, they seek to come back into the major banking system and avail themselves of the cheaper rates that are on offer. And so the opportunity for us in that situation is to partner with these funds to understand when those customers' risk profiles are normalising, and that we can see, you know, an opportunity to provide liquidity back into the fund and to take that customer on. Generally, the liquidity requirements of the funds is shorter than what you would find in a bank also. So, so even where there's portfolios of stronger clients, they want to move them on at some point to realise some of the liquidity within the fund. So again, transactionally, there's lots of opportunities for us to partner. And on the other side, it's from a risk point of view, it's very helpful having lenders that are north of you on the risk curve. And so when clients within our portfolio have some difficulty, there are lenders that are ready, willing and able, and often able to do it in a more capital efficient way than we can, given the regulation that we're subject to, and they're not, to take those clients on. And so, you know, that's just a flavour of the sort of thing we're doing. And there's a number of really good, high quality private credit firms that we've already started these sorts of conversations and have sort of informally had this sort of partnership with.
Yeah. You mentioned the alignment of broker remuneration. I mean, not all of the brokers on the same deal, and then what are you seeing in the trends in those commissions? You've mentioned that there's a lot more brokers, but obviously if you look at, say, the mortgage industry, you know, it has become very commoditised because of the growth of brokers and the expansion of their market share. I mean, you know, the confidence that that's not going to occur in, you know, SME lending.
Sure. So structurally very, very different, the two markets. I mean, the overt incentives in mortgages and residential are to, you know, to chase the cheapest price around the market. It's very much a commodity, whereas commercial lending is very different. Structurally also, you pay a broker 0.6 up front. In mortgages, there's a $600 application fee, if that. In commercial lending, it's very different. So we normally pay a charge application fee somewhere between 0.5% and 1%. So you're covering your broker cost up front. And so the propensity to churn outside of a material event or some sort of material change in the risk profile just isn't there. And as I said, discrepancies between our direct channel and our broker channel has just not been a feature of our business from either a runoff or a margin or a credit quality viewpoint. The second thing, and I'll throw to George in a second to provide any additional colour, but in terms of the question around alignment of incentives, we are looking at ways to recognise more overtly the absolute, you know, we've only accredited 1,000 brokers because of, you know, all the things we mentioned before in terms of the looking for quality commercial originators. But, you know, even the cream at the top of that group, we're looking to more overtly recognise them in terms of the delivery of our value proposition to hopefully generate additional stickiness in the book and greater alignment between broker incentive and ours. And, you know, one of the things we're doing is thinking about things like, you know, what we're calling a tied grant, which is, you know, part of our marketing budget, which is designed to promote customer loyalty. The broker, in the true sense of a tripartite relationship, is an important component of that. And so how do we integrate the broker and fund some of their marketing activity in a tripartite way? So we're thinking of just unique schemes like that. So George, I don't know if you had anything to add.
No, it's excellent, Frank. But just expanding on that as well, we are definitely seeing a structural shift at the moment, to your point, around mortgage brokers wanting to diversify into commercial, but it is a complex environment, and a lot of them are starting to realise that. I sit on the MFAA board, and we discuss diversification quite a lot. And my angle is always around mentoring or leaning on a commercial broker like the likes of Faris to help educate, upskill. But from our perspective, it's only a positive in that if you've got less experienced brokers wanting to do commercial, we've got the expertise. We partner them with commercial brokers to then get the transactions over to us. So it's working for us versus the banks, where all they're going to be trying to drive is a lot more of that commoditisation. This is where you put it. This is a system. Whereas with us, it's around understanding the customer, breaking down the problem statement, and then helping those clients and those brokers that are looking to diversify. And the other part that we're starting to see is consolidation. I think Frankie mentioned that earlier as well. Consolidation, as digitisation starts to ramp up, as the competitive environment, we're seeing a lot more bankers go out to become brokers, as we said earlier. There's a lot more consolidation, so more brokers are starting to partner with the likes of your Farris and Simplicity and a few other the bigger groups. And then that avenue is giving us more of a platform to go into those groups and then to really understanding how we can support the greater business. So from my perspective, it's only a real positive in terms of that diversification strategy. Just opens up our TAM, but also in a more measured way via the consolidation of the industry rather than us having to try and get to all those brokers ourselves. That sort of answer your question?
Thanks, George. We'll take our next question from Nathan.
Hi there, Nathan Led from Morgans. Just two questions, if I could, please, on the deposit side of things. So firstly, in the trading update, you mentioned how volatility in the swap curve had caused an expansion in the deposit spreads. Just where are we now, and how much of that sort of flowed, I suppose, into FY26, given the front back book? And then secondly, you talked today about these new business saver accounts. Thinking about that in terms of the 75% target for the overall funding once you hit at scale, how much of that are you hoping will be covered by these new accounts, which brings down your average funding cost?
Thanks, Nathan. So yeah, starting, I guess, with a bit of an update in terms of the market, and it is volatile as we have been calling out, and folks can have a look at what's happened with the swap curve. It was obviously very volatile. In particular, a month or so ago, we've seen that come back a little bit. But I think most importantly, the key, what's happened since we spoke a month ago, we've obviously now had the rate cut, so that's provided some certainty, I think, in terms of certainly the pricing or the headline pricing dynamics in the TD market, and we've been adjusting our rates down as a consequence of that. I think during the month of May we moved a couple of times, 2 or 3 times actually, with the actual rate cut being an important kind of catalyst for that. There's speculation obviously of what's going to happen next month, and I think I was vox popping a few folks out at morning tea on that and got some very different views. So we can all guess what's going to happen in July, but if there is another rate movement, that is an opportunity again for the system, and we're obviously a component of that to think about those headline pricing levels. So that's helpful in being able to adjust those headline levels for what the swap rate has been doing. But this is really, I guess, just part of the environment that we're in right now. For us structurally, and we put the data up again. When you look at the average cost of TDs, which over the 10-year period that we put up on the slide, that now includes all of the COVID noise and includes obviously all of the noise over the last couple of months. And for branchless banks, that is sitting still at a 72 basis point average. So we're still quite comfortable with that 80 to 90 range for our kind of through the cycle assumption for TDs. I think with the movement that we've seen in the headline rates of late, that's been obviously helpful. Moving towards that level. The savings account initiatives that that Frank spoke about, and we were obviously quite excited about this and bringing our proposition to a new TAM in terms of deposits. For us, this is around just giving ourselves more flexibility and optionality in terms of how we fund ourselves through TDs. So, we had a question before from Richard in terms of is this a cross sell play? It's not. It's more around giving ourselves optionality in terms of which market we go to for deposits. It's also helpful in a falling rate environment because the retail TD or the retail deposit customer tends to move to a shorter tenor, including to kind of an at-call maturity. So this is also good for us to look at this point in time from a market perspective. And of course, it's something that we can do because of what Raz has spoken about in terms of our platform for deposits moving on to Thought Machine. So that gives us a lot of flexibility and actually kind of speed and nimbleness in terms of how we develop that product. So it's not so much about us doing a cross-sell. It's not so much about us kind of changing necessarily that 75% target, but it gives us more optionality around that. And ultimately, kind of over time, it should actually help us bring our overall blended deposit costs down. We have the ability to revisit that assumption. Chris and I and the team, we talk about this quite a bit. We're just going through our annual planning and our 3-year funding planning that we do. We've got a range of scenarios in there. It's certainly a very big market, as Frank spoke about. So our ability to think about more deposit funding with the move into savings product is definitely there for us. But look, it's one step at a time. We want to establish ourselves with these products, see how the market responds, and if need be, we can update and amend those targets. But it gives us optionality, and we're quite excited about that and what it will do for our overall deposit strategy.
Yeah, just on that optionality. So having these new online savings accounts, all things being equal, should actually reduce the cost of our TDs, because we can switch where we go, and you can be more scientific around how you manage your TD book, around rollover rates and tenure and what have you, because you've got another product that you can use to fund your balance sheet if you want to sort of switch off TDs, for instance, and obviously simple supply and demand. If we need less TDs, then we won't be paying as much for them.
Yeah,
on the LC, that's MLH versus LCR, but
yeah. So question in case you didn't hear, it was around whether moving into these new products impacts the LCR. The LCR which we spoke about earlier. Look, LCRs are more sophisticated. Obviously, looks at outflows in a 30-day period. MLH is a more simpler, cruder, I guess, tool to measure liquidity. So yes, that's going to be an element that we need to balance. We've certainly got ambitions to grow, as you've heard, to the 15, 20 and beyond in terms of our loan book size. The 20, as Renee mentioned, is typically kind of that point where the LCR comes into play. So it's something that we need to balance, and it's why I don't think you'll see us have the vast majority of our deposit book come from necessarily from savings. It's certainly not our intention at this point. But it's adding that into the mix. It's giving us the optionality, as Chris said, and then the ability to effectively look across two markets to manage that. TDs are good for us as a growing bank because it has and gives us tenor on the liability side, and that's a good thing to have as a fast growing bank.
Our next question from Richard.
Richard Wiles, Morgan Stanley. I have two questions. One relates to the cost of risk and the other relates to capital. On the cost of risk, you've talked about your ongoing ambition to grow the loan book. You still think you can do 2 to 3 billion of loans per annum. You want to get to 15 billion, then you want to get to 20 billion. Chris, I think you said today your ambition is to grow beyond that. And then Renee said, while you're growing, the cost of risk is going to stay above 50 basis points. So should we simply conclude that the cost of risk will be above 50 basis points for many years into the future?
I think we've got to be clear what we mean by the cost of risk. So whilst you're growing, the charge to the P&L can be more than 50 basis points because under the accounting standards you take your provisions up front. So just so we're clear what we mean by the 50 basis points, we mean underlying loss rates. So if our portfolio was static, if it didn't grow another dollar for the next 5 years, then the P&L charge should be under 50 basis points because the only thing that's changing is your underlying losses. But when you're in growth mode, you have to take the provisions up front, which is why we always try and reconcile it when we do our full year results in terms of and we give guidance around the dollars as opposed to percentage because we're taking the growth into effect as well. But no, the 50 basis point loss rate we're very comfortable with. As I said, the whole sector, the whole system for the last 20 years has averaged 29 basis points. There've only really ever been two peaks. One was in the late 80s when it peaked well over 1%, and then after the GFC. And in both cases, it recalibrated to the mean within 18 months. So that 29 underlying loss rate, you know, you know, we're comfortable with our 50. It's slightly higher. Where does 50 come from? There was no great science. It's higher than 29. What are the building blocks of it? Crudely, it's a PD of 2 with a loss given default of 25 basis points. So 25 basis points of 2 is 50. The PD of 2 should calibrate to an over 90s and impaired numbers of about 3.3. We're at 2.59, so we're under that at the moment. The 3.3, all of our experience tells us you have a cure rate of about 40%. So the simple maths is if you're over 90s and impaired are at 3.3, the cure rate of 40% equals a PD of 2. PD of 2 with a loss given default at 25 basis points equals an underlying loss rate of 50. We're very happy with that underlying assumption with all of our growth in front of us.
But the underlying loss rate should be 50 or below. The new business strain means that the cost of risk through the P&L over 50 basis points for several years to come. That's what you're telling us.
Yes.
My second question.
Because you've got to take your collective provision on your growth. Yeah.
My second question relates to capital. I think you've said on slide 41, no new CET1 required. Does that mean that you're comfortable that if you achieve your $2 to $3 billion of loan growth per annum, that you won't get to a point where you need additional capital to sustain your growth? And could you perhaps support that answer by telling us where you think your CET1 needs to be? Like, what's the lower floor for your CET1?
Yeah. So first of all, yes, we are comfortable, but please don't be putting a dividend into your model anytime soon, because obviously largely comes from retained earnings. We still have a CET1 higher than what we're gliding to.
What are you guiding to, Chris?
Well, we've always said to assume somewhere between the regionals and the majors. The regionals, obviously, sub 10%, but they're mortgage banks with 35% risk-weighted assets on their home loan books. The majors are advanced banks, so they get the benefit of lower risk RWAs on their advanced models. But we've always guided the market to somewhere between sort of 11.5%.
And if the ROE didn't quite reach your target of low to mid-teens, let's say it was double digit, let's say it was closer to 10, does that call into question your ability to fund the growth with your existing capital base?
No.
Yeah, I mean, if we don't deliver the economics of the metrics at scale, which, you know, Chris has outlined, then yeah, it'll challenge the organic capital generation of the bank, which I think is kind of I think is kind of the point you're making. So yeah, all of the pieces are kind of reinforcing in terms of how the economics will deliver. You know, the planks for capital are, you know, one, the equity that we took largely through the private rounds, and then the final component is part of the IPO. So we started with a big, you know, dollar equity base, if you like. That dollar equity base, though, you know, through our longer term modelling, you know, does grow as we generate organic capital, and so the components of the pieces need to kind of come together. Absolutely, and it's why for us we talk so much about that NIM, because a really important part for us is the NIM, and ensuring that's a key component for where the organic capital generation is going to come. So we start with a big, you know, dollar equity base. We grow that through through the delivery of the model and the organic capital, and we grow the overall business with a carefully calibrated glide path in terms of that loan book growth, so that we're not kind of consuming capital too quickly on that journey. So, you know, lots of questions from John around kind of where we would be, and, you know, you can kind of see the bookends, if you like, of where we have been kind of growing the book. And then the final piece is obviously then the regulatory journey, which, you know, Renaud spoke about, in terms of the actual capital settings, which are obviously confidential for every bank. But all those components fit together around that capital piece. But yes, we are confident that that we're not kind of coming back to market to deliver those metrics at scale. We have, as you all know, kind of been supplementing the core capital with hybrids, AT1s when they were a thing, and Tier 2 as well, and other capital tools that we have in the toolkit too. I think that's also important. We did our capital relief term sec deal, and loan sales is another option that would be available to us and give us another tool in the toolkit. So we are running the stack more efficiently, obviously, as we grow, and as we get kind of closer to that point. But there's a number of components there that give us confidence that we have what we need and are not going to kind of come back to market, with the plans that we put forward.
I would also just double down on this, the previous answer around warehousing as well, which is very capital efficient for us. So depending on what assumptions you make around how much of the growth is through the warehousing line, then obviously that's at a much lower risk weight. We can do 2 to 3 times the volume of warehouse lending with the same capital that's required for a core SME loan.
Next question from Brian.
Brian Johnson, MST. Chris, just going back over everything you said today, quite a bit. So we can see that 75% of your flow comes from a third party. Often third parties don't necessarily have the bank lender's best interest. They want to get loans out the door. We've got bankers that seem to have higher delegated lending authority, which means they've got the capability to actually do the loan. We can also see today that basically, I think right at the beginning, you said the arrears rate has actually risen over May. When you have a look at the provision cover, it's at the lower end of some of the peers. Can you just talk to us about this rise in the arrears in an environment where you can see massive amount of excess liquidity sloshing around the system, whether it's in household deposits, business deposits, basically RBA exchange settlement accounts. You can also see that we've also had 2 lower interest rates. Why is your arrears rate actually rising?
Look, I mean, well, first of all,
if you can detail the sector or some kind of explanation.
Yeah, there's no sectoral bias. There's no read through to the economy with regards to our arrears numbers. I mean, 2.59, as I said, the thesis is 3.3. And our job is not to have that down at 1% so that we're leaving money on the table in terms of just sort of doing more commoditized lending ourselves. We are in the business of taking risk, and our job is to find the right balance between the intersection between the volume that we want at the margin that we want and at the cost of risk that we want. We are still plagued by the law of small numbers with regards to, so five customers account for 40% of that number, and there's nothing that links them together from a sector perspective. The largest one is actually a microbrewery. I think a lot of microbreweries have had a tough time with a change in consumer taste with regards to the cost of living crisis and rising input costs, etc. The second one is actually a pharmacy. It's linked to the change around the prescription rules in 30 to 60 days, and so there's less foot traffic going through the pharmacy. The third one is actually a beanbag manufacturer into the university segment, and this was impacted by a change around student numbers. The fourth one is a wholesale importer of goods to the construction industry. So that sort of goes on sort of a little bit of a cold from the construction industry, but it's a provider into the construction industry. So nothing links these customers. There was nothing fundamentally wrong with our credit assessment. It's just that sometimes things don't go your own way, and so that is still why we're a little bit cautious. We're in terms of the guidance we give on that lead indicator, because it can be a little bit choppy. But I was also state it's a gross number, so these deals are well secured. There's a $50 million loan that's in there that is very well secured. I mean, like, it's a 50% loan to value transaction, so we're not going to lose any money on it. So there's no read through of the 2.59 to an underlying loss rate. I mean, we use averages of averages, And as I said, the core maths is if that number gets above 3%, then we would start to be concerned, because it would suggest a PD that's higher than 2%. But again, it largely depends on the mix of customers that are in that particular cohort at any particular point in time.
Chris, just a second question which flows on from that. Shut up. So when you have a look, I've never ever been to one of these presentations where everyone does say we've got the best bankers. Have there been any cases of the bankers tipping in a little bit more when the loan was actually probably already troubled? So has there been bankers that are exercising their delegated authority to tip in more?
So first of all, they've got no incentive to do that. They're not on sales commission. There's no stand in the naughty corner if you've had a bad debt. You know, there's none of those cultural attributes to our business. One thing I would say is, so the empowerment that we give from a customer value proposition means that the customer can meet the decision maker, and that decision maker can make a decision quickly. Every single loan, every single one, 100% of those loans that are done by the bank are hindsighted by credit. So they are still reviewed afterwards. Now it's after the decision has been made, but if the people in Renee's team and that hindsighting believe that there was something untoward around that particular decision, then the belt will be removed straight away. And when we have procedures and processes around that, so
how often does that happen, Chris?
Oh,
I can take that one, Chris.
Yeah.
Very infrequently. So Renee and I both sit on our off-track panel, our consequence management framework, and it is very few and far between that we would see instances of malicious behaviour from bankers. And I think in the last 6 months alone, it might be two.
Two.
Yeah.
It's been two.
Yeah.
Take our next question from Tom.
Thanks. It's Tom from Citi. Just a question around the metrics at scale with regard to costs. I know, Chris, these were set many moons ago, and we've had a lot of inflation since then, tech spend, and we're still adding new capabilities like savings deposits, which would have a cost attached to that as well. Nevertheless, the 30% or approach to 30% cost to income is stuck. Does that reflect a slower approach to that 30%, or are you more confident that the operating leverage will cover these cost imposts that we're seeing?
Yeah, no, look, it's a great question. I mean, we always said that the metric scale will not all happen at the same time. The first one that will happen, obviously, is the NIM. We're pretty much already there, over 3%, or we are already there, over 3%. The cost of risk is through the cycle assumption that we've just said, and we certainly don't have an underlying loss rate of over 50 basis points as we sit here today. The costs are levelling out now. They are definitely higher than the financial model that we had when we were at the time of the IPO, as you said, largely as a result of inflation. And just we've probably expanded. I think there's been a significant amount of wage inflation in particular with regards to bankers. All the major banks have fallen back in love with recruiting business bankers. In terms of the CapEx, we flagged at the time of the IPO that it was going to be 100 million for 5 years. We've spent 90 of it, but we're pretty much at the end. We will definitely go over 100 million. I mean, we think about our CapEx rate of about 20 million a year. But I'm pretty proud of the fact that back in 2019 we weren't that far off, in terms of costing out what the full replatforming of the entire bank would cost, and we're pretty much bang on what we said we would be. So the key determinant of the cost-income ratio is revenue, right? And I think, at a $20 billion book, depending on what NIM you put in, if you put a 3.1 NIM in versus a 3.5 NIM in, you'll get a different cost-income ratio. Our job is obviously to expand that with augmenting our product set. One of the things we think a lot about is other operating income. So everyone wants to talk about NIM, but there's other operating income. There's a lot of things that we can do. We only have 4 products. We haven't yet started to think about how do we solve some of our customers' other needs with regards to white labelling. We don't have a receivables finance product. We don't have a trade finance product. We don't white label corporate credit cards or FX solutions or what have you. So all these are in front of us. So we're confident around the metrics at scale. The exact path to them, is in front of us, but we have plenty of levers to use.
We have one final question from Ed. Thank you.
Thank you. Ed Henning from CLSA. Thank you for taking my question. I just
wanted to circle back to John's initial question on the runoff. You gave some good detail on the COVID hump and also the 20%. But obviously, you've grown over time and got bigger, and your customers have got bigger and grown with you. And with that runoff, though, and we spoke to some of your customers today, and they were talking about, the bigger they get, you get offers from major banks. Can you just talk about in your planning and how you think about, as you see the runoff and that 20%, are you concerned that they're the bigger customers rolling off, where you're writing smaller customers on a smaller loan base, and how we think about that with your growth going forward?
Yeah, no, it's a great question, and again, it's averages of averages. So just to unpack, where did the thesis of 20% come from? Bear in mind the big banks theirs is higher than that. 8% is structural. So 8% of our book rolls off simply because of the way we've structured the facilities, so capital and interest repayments. About 5% is what I would class as asset sales in the ordinary course of business, and we're certainly experiencing that, where customers are either deleveraging or just selling assets, or in Army's case, selling entire businesses. Now, we've had it happen a couple of times, as was talked about earlier, but when you're, NAB, if one customer is selling an asset over here, there's a good chance a customer over here is buying it, and so it sort of washes itself out. We're generally only one side of that equation, but as we get bigger, there's a better chance we'll be on both sides of that equation, particularly if there's a broker involved, or we're able to play a role in connecting, businesses together, as was talked about earlier. Then there's 5%, which is just other stuff. Sometimes it's us encouraging the customer to leave because maybe there's a deterioration in their credit worthiness, and we might be referring them to private credit, or taking a stance which is different to their own, or maybe the loan has become completely commoditized, and we just believe we're better off recycling that capital than we are keeping it on the books at a sub-economic return. That all adds up to sort of 18%. We rounded that up to 20%. As I said, it's been higher, it's been largely the latter, where there were loans that we originated during the COVID era, where the banks were closed, they didn't want to do them. We did them at a certain price because we had the term funding facility that has normalised, and we just have a decision to make as to whether we certainly have a better understanding now than we did 5 years ago about what a Judo customer looks like. And so if we do have a customer on our books that we don't believe particularly values our CVP anymore, they don't really need the relationship, they're a mature business, they're not going to be doing it much, and if the economics are below our cost of capital, then generally we're okay, because there's nothing wrong with our origination machine, right? We can originate assets. So letting a customer repay at 2.5 over swap and re-originating that loan at 5 over, is something that we're going to do. I know it makes it hard predicting exactly what the rate of growth is going to be, but for me, it's the intersection between the growth, the NIM, and the cost of risk that's most important, and we will not just be growing at any price and damaging our NIM as a result.
And with that, I guess you see obviously capacity in your bankers, and obviously growing your bankers, and also the broker market. So if you do have higher value loans roll off, you might need to roll on multiple smaller loans, but you've got that capacity in your system, and that's part of your plans, I guess, in your growth.
That's right. I mean, as I said, again, averages of averages. So the building blocks of $5 billion of originations is one loan per banker per month at $2.5 million. Well, we have we have customers that are borrowing 50 million off us. So if that banker does a loan, we don't say you're done for the year, right? So we've got plenty of capacity, and even more so now that we're really into the re-engineering of our processes. There's no doubt about it. If our bankers were set here today, the processes that they operate with are not as efficient as the processes we promised them at the point of recruitment, because we have been distracted by the infrastructure required to build a bank, the re-platform from tactical investments to the more strategic platforms. And obviously, when you're in the middle of re-platforming, you don't go re-engineering all your processes at the same time. So that's been the hard work of actually how do you build and scale a bank from scratch. But as I said, it's all largely in the rearview mirror now. We have all of the platforms that we need, and we're really getting into a phase now of capacity release for our bankers at the same time that we're recruiting new bankers in new regional centres where they literally start with a blank, with an empty portfolio. And I think if you're modelling run-off rates, you should be thinking about the warehouse business as well, because that obviously is more replicating in nature, because the underlying borrower is generating their own receivables, and so as that pays down, if we're doing our job correctly, there'll be new receivables coming in to replace them. So that shouldn't have a run-off rate anything like as high as the core business. It's pretty much done. It's pretty much done, John. Yeah. I mean, Ben, do you want to? I mean, Ben can talk to that because Ben, knows these customers literally customer by customer. But we're largely coming to the end of this.
Yeah, that's exactly right. So we are. I mean, most of those loans have now run off or come off, or even actually converted out of a COVID-style loan into something else because the customer may have gone and done something else, but we've continued to support them. So yeah, we should see that kind of normalise in terms of the runoff of those type of customers. I think to Chris's earlier point, we have seen though an increase in kind of asset sales over the last 6 months as customers have deleveraged as well. But I suppose now going into the market now with interest rates kind of coming off and hopefully continuing to come off, we should see that also slow as well. So I think, yeah, in terms of your thinking, the COVID loans that we wrote will have kind of stabilised or no longer be running off.
And then asking for an estimate. So it just seems really optimistic that only 5% of your customers are going to leave unless you're going to.
Well, we've got an NPS in the 60s. We will. I mean, don't get me wrong. We will follow the customer down in terms of price. I said the range is between 2 and 7. We do not. In the ordinary course of business, I do not want to tell a customer, I'm sorry, your credit worthiness is too good for us now. We were happy to see you leave. But yes, absolutely he will. Yeah. No, absolutely. Yeah.
So we funded Dan into this farm that he's been looking at since he was 5. So he'll probably buy another one, and he'll want to develop the next Mudgee industrial complex, right? So we always, they don't stop, and that's why customers like Dan are ideal Judo customers, because they continue to do things.
Raz made a point earlier that one of the highlights we said was we've changed the process for how easy it is for a banker to change price from 30 minutes to 2 minutes. That's because we change price a lot, right? So sometimes it'll go up, sometimes they've missed a covenant, or there's a deterioration we want to add 50 basis points on. Sometimes we'll take it down, right? So our pricing is dynamic. These are not mortgages where it's set once and we never touch it again. We are moving price constantly on our customer base. Oh, in terms of what, the money we made off the TFF?
Thanks, mate. We've been wildly ambitious with our agenda, saying that Q&A would finish at 12:30, but we should take our last question from Jason, and then we'll head out to lunch.
Like your last, Jason Shower from Macquarie. I'll just ask one question. I mean, you've introduced all these new initiatives recently in slides, well, such as savings, warehousing, and some of the other ones listed here, but you haven't really changed your at-scale metrics. I'm wondering, is it just because a lot of these initiatives are quite new and you're still waiting to see the impact of them financially? Or do you see risks to your core SME lending and term deposit business, and that's sort of offsetting some of the pressures there?
No, look, it's more the former, Jason. So I mean, taking the deposit investments for, as an example, we want to establish ourselves in the market. We know that coming out with a new product into a new TAM, takes a bit of effort. It was not that long ago actually when we were putting our first TD out in the market, and you've got to establish yourself, and so that just takes a bit of time. And we want to see how that goes, and how long it takes us to kind of ramp that up. Now we've got, don't get me wrong, very good folks in our business that have done this before at other shops. I mean, our TD team are all kind of ex-U Bank and ex-ME Bank, so they know how to do these things, and so we have an expectation on how these things will work. But ultimately, you've got to establish yourself and do it in the right way and do it in a measured way. Warehouse lending is an example of that. I mean, Chris spoke about some of the challenges that we've had, not at all with the opportunity or the size of that pipeline, but actually just when you actually get into it, getting those customers onto their first bank warehouse and what it means for them. So, these are all levers that we have. They're all options that we have, and we're quite excited about it. But you wait until you've actually got a bit of a track record there before kind of being too specific about contributions to the overall economics. But we're quite excited by this investment slate. The investment slate to date, as Raz has spoken about, has been a lot about just getting these foundations in place. But we've got a really interesting and exciting portfolio of things that we're going to work on over FY26, and we're really looking forward to bringing some of that to market.
So in theory, those metrics could improve.
Well, it certainly gives us optionality around those metrics. I mean, as Chris said, what the deposit move into savings does, it gives us potentially, and we're not kind of saying this is an FY26 thing, but potentially gives us a funding benefit. Now, how that rolls through the business, whether it goes to NIM, and so therefore would go, I guess, to one of our metrics of scale, or whether it goes to how we think
growth.
about the growth opportunity and what it means in terms of being able to service our customers. So there's options there, I think, and that's that's all ahead of us.
So we'll call that a wrap. Thank you so much for your time. I think we've taken 4 hours of your day, so we really do appreciate you joining us this morning. As I said, we love talking about judo, and we really do appreciate your support. So thank you again for joining us.